Okay, we're back again. And today we're going to talk about chapter 6, 7, and 8. So, without any further ado, it looks like everything is working properly. I don't see any problems here. So, let's go ahead and get started. So, in chapter 6, we're going to talk about retirement benefits and individual retirement accounts, also known as IRAs. And in this chapter, we're going to talk about Social Security benefits, retirement income, common types of retirement plans, what a contribution is, what a distribution is. I've skipped the simplified method for this class. It's really kind of a rare thing outside the scope I consider for this type of class. I'll talk about required minimum distributions, qualified charitable distributions, rollovers, penalties, and early distributions. I want to determine the taxable portion of Social Security benefits, if any. Learn about the different types of retirement plans, and figure out on retirement plan distributions what's taxable, what's not. Distinguish between the different types of IRAs, why each one has the benefits of each. How to roll over plans, make direct transfers, and just kind of get an understanding of the rules that are involved with IRAs. Some of it's a little bit beyond the scope of a tax class, so I'm going to creatively edit as we go along also. But we know that Social Security has been around a long time, since the Franklin Roosevelt administration in the 30s. They're made under Title II of the Social Security Act. They include old age, survivor, and disability insurance benefits. Certain government retirees who receive a pension from work are not covered by Social Security. The current Social Security system is set up like this. When you work, you pay taxes into the Social Security system. Those Social Security taxes are collected from all workers that are used to pay benefits to people who have already retired, people who are disabled, survivors of deceased workers, and dependents and beneficiaries. They're not held in an account under your Social Security number. It goes into a general pool that's used to pay out for now. So when you retire, those people that are working at that time are going to be the ones paying your Social Security. Any unused money goes into a Social Security trust fund, where, now, let's just hope the government leaves it alone and leave it at that. Benefits are the monetary benefits received by retired workers who have paid into the system during their working years. They are paid out monthly to retired workers' spouses and or their surviving spouse. They are also paid to those who are permanently and totally disabled according to the strict criteria set by the administration. Do not include supplemental Social Security income. That's never taxable. So here's our form. I don't know why they could have done better with the picture here, because this form actually has a little bit of color on it. This box right here is actually a little pink, and some of this up here is also a little pink. Alright, so depending on the amount of other income and the taxpayer's filing status, Social Security benefits may be entirely tax-free, or some portion, up to 85%, never 100% of the benefits, can be included in gross income as taxable. These benefits show up to you as being paid on a SSA 1099. If you work through the railroad, they have a similar program, but it's managed differently. Instead of the Social Security Administration, they are paid into the Railroad Retirement Board, RRB, and they get an RRB 1099. Treat them basically kind of the same. Social Security equivalent benefits. This is what an RRB 1099-R looks like, and I want to warn you in advance. Be very careful when you're looking at these forms because there's also a RRB 1099-R, and it's different. It's for a pension and from the railroad. The problem is that it looks similar to this, and so really look. There should be somewhere down on the bottom down here. It should have a bar that says what type of form this actually is. It was cut off for this, but usually there should be another thing down here saying an RRB 1099-R. You know, like we said, if you work for the government and you're retired, you might not get full Social Security benefits except for jobs that you work that weren't government, but they are in the government retirement system. They get a CSA 1099-R. And again, it's different. But again, it'll say down in the bottom that it's a CSA. And that tells you they were a government employee retired. So 1099 SSA, RRB 1099 use the same worksheets, follow the same rules, determine if any of the benefits are taxable. Report the Social Security benefits on the tax return to the person with the legal right to receive them. If you see an SSA 1099 for a minor child, I like seeing that form. It's a proof of residence. It's great for me. But it does not go on the parent's return. It would go on the child's return if the child is filing a return. Some percentage of your benefits will be taxable if your total income plus 1/2 of the net benefits shown on box 5 of your SSA 1099 exceeds the up here in a little bit. If you're married filing jointly and both spouses receive benefits, use 1/2 of the combined benefits. Generally, as your total income plus 1/2 of your Social Security benefits increase, the greater percentage of your benefits are subject to tax. And if you're married filing separate and you live with your spouse for the entire year, you're automatically become some of your benefits will become taxable. So already another thing about married filing separately and how it's not the greatest of deals. So here's our chart. Keep in mind that this will change. This is the 2024 chart. I failed to look for the 2025 chart. My mistake. So if you earn, and your filing status is married filing jointly, if you earn $32,000 or less than that, so your income plus your tax exempt interest plus 1/2 of box 5 of your Social Security SSA 1099 is less than this amount, $32,000 for married filing jointly, your benefits are taxable. And we see 25 for head of household or qualifying widowers, 25 for married filing separately and live with apart from your spouse for the entire year, or 0 if your filing status is married filing separately and you lived with your spouse at any time during the year. So automatically, married filing separately, lived with your spouse, 50% of your benefits are going to become taxable. So between 32 and 44, 50% of your benefits are going to become taxable. Once you exceed these numbers down here, 44, 34, and again 0, you're up to 85% of your benefits. So there's only 3 stops on this: 0, 50, 85. And people that are freshly retired aren't going to, unless they're really savvy, really looked into it, they're not going to understand what's going to happen here is that, they think that their benefits aren't taxable. And they might have even asked the Social Security people, hey, how much can I work before it affects my benefits? And the answer is going to come back, well, you can work as much as you want. It won't affect your benefits. Which, that's a true statement. Well, a guy came in and argued with Brenda about this, and she called the Social Security Administration to help him get an answer because he was not believing what she was telling him. He thought she didn't know what the heck she was talking about. He was going to get his stuff and go. So she offered to call. And the guy, again, said the same thing. Asked her, how much can I work before it affects my Social Security benefits? The answer came back again, you can work as much as you want. Which is, again, that's a true statement. So Brenda took the phone and asked the question this way: how much can he work before the benefits become taxable? Well, the response from the Social Security agent was, well, he didn't ask that question. So, and then we got down to this. We got down to this chart. Well, he can work this much and then becomes taxable. So, just be prepared for, especially somebody that's newly retired. They don't understand all of this. It's not something that's voluntarily explained by Social Security Administration. It's not something that's, is commonly known. And the worst part is that for a lot of our clients, this might only be a one-time thing. If you retired late in the year and you worked for most of that year, yeah, you're going to be over these amounts. So it might be the only time that you are. Next year, they're retired. They didn't work all year. They were just getting whatever their distributions were from the IRA, if they needed any. And so if they keep it below these numbers, yeah, none of it's going to be taxed. So it might be a one-off thing. It might be something they need to look into for having withholdings on their Social Security, because if they continue to work after they're retired, or have other income, because keep in mind, we're looking at all income plus tax exempt interest, whether you're working, pension distributions, IRA distributions, rental income because you bought a bunch of houses that you're renting out. All sorts of income is counting against you in this. So to figure the taxable amount of the benefits, add 1040 lines 1, 2B, 3B, 4B, 5B, 7, 8, plus 2A, minus any adjustments from Schedule 1, lines 11 through 20, 23, and 25. Then the following exclusions must also be added back in. If you had adoption benefits, if you had foreign earned income excluded, or you had earned income in America, Samoa, or Puerto Rico by a bona fide resident of those locations. Have to add all that back in to figure out your taxability of your Social Security benefits. There is a form publication for you, publication 915. Also a publication 590A. All of this will help you determine the taxability of your benefits, give you some insight of what you can do. It has the worksheet. Also, there's also a worksheet in the 1040 instructions, but since that's not really mailed out anymore, go to the IRS website. You can find a worksheet, give it to your client, because obviously when you put this information in Fusion, Fusion runs the worksheet in the background by itself. You'll never see it, even though it exists. You can print it out. It exists there, but if you need a blank version, just go to the IRS website, look for the Social Security Benefits Worksheet. Remember, the Social Security Benefits Worksheet also applies to the Railroad Retirement Board. During the tax year, you may receive a lump sum of Social Security. This is a retroactive payment of benefits. Sometimes Social Security Administration takes a while for them to decide whether or not you qualify for benefits. I mean, if you're retiring, that's one thing. If you're trying to get on disability, that's another, because you got to prove that you're disabled. And they're going to look into it to make sure that you're just not working the system. And it might take them a while. Well, if it does, and then they decide that you should have qualified from the get-go, they will pay you back to the time that you first applied for the benefits. This is a lump sum. Well, as we saw earlier, that might be a bad thing, because maybe I went back to work a little bit, or other things like that. I'm still on disability, but I'm working a little bit because I found a job where, it's part-time, seasonal, something like that, I can put up with it with my disability for that short amount of time. So now I might have taxable benefits, but in previous years I wouldn't have, and some of this lump sum election would have been from those previous years. Well, by exercising this election, I'm going to pull out a worksheet that's going to allow me to break down how much of this lump sum election is for this year, how much of it was for the different previous years, and it's going to break all that back out and refigure the taxability of my benefits. And I don't have to file amended returns for the previous years. This worksheet will cover it for you. But you would need to know you'd need a copy of the 1040 of the previous years, if there was one. So, and if there wasn't one, well, that makes it easy. There's zero income, so obviously none of the benefits would be taxable for those years. But you can see where this is kind of going. It breaks it down. The worksheet will do all the math if it was taxable in the previous years, but at a different rate. The worksheet is actually equipped to handle that. Again, don't file amended returns for those years. That's not what you don't do that. This worksheet will take care of it for you. And then when you put this on here, you have to tell the IRS why the taxability is different from what they're expecting. There'll be a box on Fusion to put in this LSE. It'll show up on the Social Security Benefits 6B of 1040. It'll just show up right there on the line LSE, lump sum election. The IRS will then understand to look for the worksheet to make sure that it was filled out correctly. Of course, if you're using Fusion, chances are pretty good that you got it right. And then it'll change it. And then the IRS won't have any questions about it. So that's Social Security. Let's talk about retirement plans. See, the retirement plans are a means to save for money for retirement while you're still working. You set up plans through your employer, or you can go straight to financial institutions, whether it be some brokerage house or even the bank. You run down to the bank, they'll hook you up. The taxability of money put into the plan will determine the tax treatment of the money when it's taken out of the plan. This is a big thing. So tax deferred, which is what most people are on when they're participating in a retirement plan at work. This is tax deferred. They're making the money. It's going into a retirement account, tax untaxed. You'll pay taxes on it when you withdraw the money. Retirement plans may be fully taxable, partially taxable, or not taxable at all. Tax treatment when a distribution is taken out of the account depends on whether the account was funded with before tax or after tax contributions. Before tax, that's the one that you were thinking about. You're participating with the plan at work. It means you did not pay any taxes on the money at the time it was contributed, so have no what they would call cost basis in this plan. So, for an example, you received a tax deduction for the amount of your contribution, or you contributed to an employer-provided plan and did not include the amount of the contribution in box 1 of your W-2. And therefore you had the box 12D amount. These are before tax dollars, also sometimes referred to as pre-tax contributions. So therefore, since it was not taxed ever, it's going to be taxed when I take it out. After tax means that I've already paid taxes on the money that's in the plan. So I have a cost basis. I have money in there that I've already paid taxes on, so that when I take it out, I don't have to pay taxes on it again. However, depending on the type of the plan, income earned in the account will be taxed when it's distributed. That's not up for you to have to keep track of. That's up for the brokerage house to keep track of. So when you say, hey, I need 10 grand out of my account, it's up to them to figure out how to break that down. Okay, I have that 10 grand. 8,000 of it is his money. 2,000 of it is what it grew, so I'm going to pay tax on 2,000. which is basically what I just said here. If you make all the contributions to a plan with pre-tax dollars, the entire distribution is fully taxable. This is the most common way. You work for aircraft, you work basically any place that's put in a 401k, SARSEP, simple plans. The money that's going in was tax deferred. By making these tax deductible, well, I hate using that term, before tax contributions, you benefit by reducing your taxable income now. That's good, and then hopefully that when you're retired, you're in a lower tax bracket when you take it out. So, net long-term savings. I didn't pay taxes on when I was making money. It would have been a higher tax rate. When I'm retired, I'm not making as much money. I'm not getting as much money. So hopefully I'm in a lower tax bracket. So when I take it out, it doesn't hurt as bad. Withdrawals from your retirement accounts before you reach the age of 59 and a half are subject to a 10% additional tax. Call it an early withdrawal penalty. There are some exceptions to that. We'll talk about that here in a little bit. Different types of retirement plans. We have pensions. These provide specific payments to an employer or survivor after the employee retires. Annuities provide payments under a contract from an employer or insurance company, trust, or individual. Defined contribution plans. This is the most common: 401k, 403b, simple IRAs. Allowed either the employer or employee to contribute pre-tax funds. That might be it too. Matching funds. Think about that for a second. One time I was working for a place that I could contribute up to 10%. They would match up to 5%. So automatically I'm putting in 5%. I got a 5% raise. I just don't have the money right today. It's going into my IRA account. IRAs are individual retirement arrangements set up by a taxpayer with a financial institution or a plan administrator. You went down to the bank, you went down to Merrill Lynch, said, hey, I want to set up an IRA. Cut them a check. They set it up for you. You've done it. You might be able to write some off of this contribution. We'll talk about this. Contributions to pensions, annuities, defined contribution plans. If you're covered by certain types of retirement plans, you can choose to have either part of your compensation contributed by your employer to a retirement fund rather than have it paid to you. The amount set aside is treated as an employer contribution. That's an elective deferral. Contribution is not included in taxable wages. There's no cost, no basis in the plan. All the money that's in it will be taxed when I take it out. Again, we're referring to that. This is a W-2. I already said this. We have box 12 down here with a D in it and some number. That's the money that's going into the 401k. And right now, as a tax preparer for this year, don't care. This number means nothing to me. Elective deferrals include elective contributions to retirement plans, cash or deferred arrangements like a 401k, thrift savings plans for the people working for the U.S. Civil Service, salary reduction, simplified employee pension plans, also known as SARSEPs. That's more for your mom and pop. Tax sheltered annuity plans, a 403b, savings incentive match plans for employees, also known as a simple plan. Section 457B plans, government deferred compensation plans. All of these are types of retirement plans that have at least a portion of taxability as you take money out of it. Elected deferrals are limited up to a total of $23,000. A little bit higher if you're 50 or older. So $30,500 for 2024. Simple plans are a little bit different, lower numbers. 457 plans have a special catch-up 3 years prior to the retirement age to contribute twice the annual limit, or the basic annual limit plus the basic limit not used in previous years. So, this is not really important for us as the tax preparer to know this information. I mean, it's enough to know that there are limits and to have an idea that's a limit. But it's more important for their plan administrator to keep track of these limits. Because if you go over them, you will pay a 6% excise tax on the amount of money that you contributed over these amounts. So, yes, it's important to keep track of. Really, it should fall to the plan administrator to keep track of it. Can't defer more than 100% of your taxable compensation or the limit. Well, yeah, if I didn't make $23,000, doesn't mean that I can contribute $23,000. I didn't earn it. And so that makes a little bit of sense. The employer or plan administrator should apply the proper annual limits when figuring the contributions. However, the taxpayer is responsible for monitoring the total deferred to ensure that they don't go over. And like I said, if you go over the limit, you're subject to a 6% penalty for the excess contributions, the amount of money that's in the plan that's over the limit. An individual retirement arrangement, IRA, personal savings plan, offers tax advantages. IRA belongs to one individual. You'll never see an IRA for husband and wife. You'll see one for husband, you'll see one for wife. An IRA may be either traditional or a Roth. This is the first time we've talked about a Roth. And Roth has a lot of good things going for it. Traditional IRA is any IRA that's not a Roth or a simple. You may be able to deduct a contribution to a traditional IRA, and these amounts will not be taxed until distributed. There is an adjustment to income that's available. We're not going to talk about adjustments to income in this class. There's not a lot of them that are used on a regular basis. So that's a basic class concept, not a rapid class one. But I will talk about this here just for a little bit. I have a client or two that they know that they're going to the IRS every year. That's part of their plan. But they're keeping it within a reachable amount. And so they come in, they give me their stuff, find out how much they owe, and his next statement to me is going to be, how much can I put into my IRA to make that go away? He's not looking for zero. That would be acceptable for this guy, zero. All right, well, I start plugging numbers into adjustment of income, keeping in mind of the limits. Like I said, I start plugging in adjustments to income to make that number go away. And when I get to a number that he can live with, he runs down to the bank or down to Merrill Lynch, cuts him a check for that amount. He comes back with the receipt. I plug that number into tax return, make that number go away. He's a happy guy. So instead of paying the IRS, $3,000, $2,000 because he didn't have enough withheld, he paid himself that $2,000. He put it into his IRA and made his tax amount go away. It's kind of a win-win. Contributions to Roth IRAs, on the other hand, are not deductible. And the distributions are not taxed at all as long as you take them out following the Roth IRA rules. So, hey, you don't want to worry about paying taxes on your IRA when you retire? Get a Roth. Like I hinted at in my previous example, you can make IRA contributions for the current tax year up to the due date of the tax return for the year, not including extensions. So as long as my guy who's using the IRA deduction to basically pay for the taxes he owes the IRS, as long as he shows up before April 15th, I can make it work. If he shows up late, well, then he's going to have to cut his check to Uncle Sam. So Charlie contributed to his IRA on April 15th. He could choose to make this contribution for his 24 tax year or his 25 tax year. but he has to notify the plan administrator of what year he's going to put it in. Like my guy, he's always put it in for last year. So he would come in and say, well, he would tell the guy, I'm going to put in my 24 tax return. And that way he could take it off his 24 taxes. Like I said, there's a limit. The most that he could put in is $7,000, although he is over 50, so he can put in 8. So let's hope that he can keep it below this number. And remember, it's not dollar for dollar either. So, I mean, if I show that he owes $7,000, he's going to pay the IRS. But I could still make the number more palatable by still saying, okay, well, if you put into your IRA, we'll get this down. So, let's see how far we can go. And I have to have taxable compensation. Total taxable compensation includes earned income for wages, self-employment, as well as disability retirement benefits until you reach the age that you could have received a pension or annuity. So I'm retired on disability. I still get to count it as earned income because I haven't reached the minimum retirement age. Talked about that a little bit last time. So all of this counts as taxable income for the purpose of being able to contribute to an IRA and be able to write it off. This list here doesn't count. So if I'm only making money from rentals or interest, dividends, pension or annuity incomes, especially if I'm doing it for pension or annuity incomes or deferred compensation, I'm retired. I can't take I can't put into a retirement fund, get a benefit for it, and then turn around and take it right back out. Can't do that. If you have earned income, even if the spouse didn't work, you could still go ahead and put an IRA in for the spouse as long as you're married filing jointly. So, spouse didn't work, we could still put in money at the same rates and still take a tax deduction for it even though the spouse had no taxable income. Just as long as the two of you combined have enough income to cover at least $7,000 or $8,000 if you're 50 or older. Then if you're both putting in, of course, $14,000 if you're both under 50, $15,000 if one's over 50, and $16,000 if you're both over 50. And keep in mind these numbers will also change depending on the years. 2020 and later, there's no age limit on making regular contributions to a Roth or traditional IRA. 2019 and prior contributions to an IRA could not be made for the year in which taxpayer reached the age of 70 and a half or any later year, because basically what you reached here is you got to a point where you have to take a required minimum distribution. You can't leave your money in a traditional IRA, especially after you reach age 70 and a half. You have to start taking it out. You don't have to take it all out. You just have to take a little bit out. And again, it's up to the plan administrator to decide, to figure out the amount of money that was taken out, that needs to be taken out. And if you don't reach that number, you pay a 50% tax on the amount of money that you should have taken out but didn't. Alright, so I already talked about this, taking the IRA deduction, but that's only for traditional. Can't use it if I'm going to put it into a Roth IRA, which we still haven't gotten into. And I also have to be careful if I'm contributing to a plan at work. I could do both. I could contribute to a plan at work. I can contribute to an individual IRA. I can still take the IRA deduction, but there are limits to that. And so, first and foremost, again, those limits are going to start triggered in when I have box 13 checked, retirement plan. Whether or not I was actually participating in the retirement plan at work is irrelevant. The fact is that box is checked. That triggers certain caps. So this box here being checked even if I didn't participate in it, like we're seeing here, there's no D in any of this. So I was covered. I've seen it. I was covered by retirement plan at work. Didn't participate in it. I wish we'd get to the slide where it says. All right. So Nick and Rebecca filed jointly. Their total income is 130. They each have a traditional IRA. Nick put in 35. Rebecca put in 4. Neither spouse is covered by a retirement plan at work. They can take an IRA deduction of $7,500, which lowered their adjusted gross income to $122,500. And they still have the option here of putting in a little bit more. Remember what the limit was for both of them. They haven't reached the limit. If they wanted to lower their adjusted gross income even farther, there's still some room here. And if it's not April 15th, they still have time. If either spouse is covered by a plan, the filing status and income must be considered for the amount of the IRA deduction. We have to look at the modified adjusted gross income, which in this case would be the adjusted gross income ignoring the IRA deduction part. Worksheet here for you. These are the limits. If you're covered by a plan at work and your adjusted gross income is $77,000 or less, then I can take a full IRA deduction. So I could go out and put more money into a different IRA plan that I had set up at the bank. So my guy coming in, he would fall under this category. And still take up all a full deduction of all the money that he put into it. And of course, if he made over $87,000, then my hands are tied. I can't do anything for him. This is, again, if he was recovered by a retirement plan at work. And of course, married filing separately doesn't get a full contribution. Limits start at $10,000, or limits start at 0, and no deduction starts at $10,000 of adjusted gross income. Again, if you're not covered by a retirement plan at work, then the other amounts were in effect. Married filing jointly with one spouse who is covered by a plan at work and the other one's not, they allow for that. Remember, think about that for a second. Look at it. It's 123, 230. So there's a lot of wiggle room for here. And again, married filing separately still at 10. So Donald and Daisy Duck are married and file a joint return. Both recovered by the plan at work. They're both under 50. And modified adjusted gross income is 144. Donald put in 32. Daisy put in 4. And find that they can't write any of it off because they've made too much money. Now, if we change that and say Daisy's not covered by a plan at work, so that bumped it up to 230 on the cap, she can write off all of the $4,000 that she put in as an adjustment to income. Remember, the IRA belongs to you. The contributions to it are yours. So the table determines the deductibility of your contributions. Although you may not be able to write it off, you're still allowed to put money in. And we have to keep track of that. Because if I was putting money in and I didn't write it off on my taxes, I didn't receive any tax benefit, and this money has already been taxed because I'm writing a check for it. I'm the one putting it in, not being withheld from my paycheck. So that way, when I take it out, I don't have to pay taxes on it. Well, we need to keep track of that money throughout the years of what's in this account that I was able to write off, what's in the account that I was not able to write off. We keep track of that with Form 8606. Once you start filing 8606, you must continue to file 8606 until you take all the money out that was put into the account that wasn't taxed. If you forget to file this form, you're going to lose track of the money. The IRS will say, okay, well, everything in there as you take it out is going to be taxable. So we have to keep track of it. If I don't have a filing requirement for a year, I still have to file 8606 for the year. I can file it by itself. It's a standalone form. Fill it out, mail it to the IRS. That way they keep track of the money that's in my plan that I could take out tax-free. Which is basically everything what I just said here. And this is, again, what we're keeping track of. So for our example here, let's see here. He's put in $60 this year that he was not able to write off. He already had $800 in the account that he was not able to write off. And so now we've added everything together. He's got $860 in the plan that he can take out tax-free. Because he did not receive any benefit from putting in there. So Roth's a bit of a different duck. They're subject to somewhat different rules and somewhat similar rules, but the tax treatment is way different. Income limits are exceeded. You're not allowed to put into a Roth. Contributions to a Roth are non-deductible because when I take the money out, it's not taxable. I can only put in $7,000 or $8,000 if I'm 50 or older per year, or whatever my taxable compensation was for the year. If I only made $2,000, I can only put in $2,000. So again, we're subject to our limits also. And we've seen these numbers on the previous one. Get married filing separately is a whole problem. If you contribute to both Roth and traditional, your contribution limit for Roths must be reduced by all contributions to all IRAs other than your Roths. So if the allowable limit of your contributions to your Roth IRA is exceeded, you are subject to a 6% excise tax. So I could put in 2 IRAs, but those all add up first. Because again, Roth is so powerful at the end that they don't want you to basically take advantage of the whole thing in a bad way. So we take distributions out, we get a 1099-R. R for retirement. Lots of information on here. Box 1 is how much was actually paid to our client. Box 2 is the taxable amount. If it's not filled out, and especially if box 2 here is checked, they don't know how much of it was taxable, at least at the time that it was coming out. Have to get more information to figure out whether or not this should be blank or there should be a number in here. It's up to your client to go back to their plan administrator to discuss with them why or what should be in this box truly. It could be 0, especially if you're taking out from a Roth. Hey, I took out $5,000 from a Roth and I did it the right way. Taxable amount is 0. That's acceptable. We know that there's a possibility. Box 4, income taxes that were withheld on the distribution. Box 5, after-tax contributions that recovered tax-free for the year. 7 is the code that identifies the reason why it was distributed. Traditional IRA distributions are indicated with an X here. Roth IRA distributions are indicated with the code J, Q, or T. And this box is blank because it's not a traditional IRA. Like I mentioned before, if you're working for the railroad, they have their own pension plan. They get a CSA 1099-R or a RRB 1099-R. Treat those just basically the same way as you would a 1099-R. It's the same type of concept. Traditional IRA is usually funded by deductible contributions, making all deductions taxable. When distributed, the taxpayer is generally not required to compute the taxable amount because we already know. However, if you've made non-deductible contributions, you need a copy of the most recently filed 8606. And like I said, if you lose track of this information, well, you're out of luck. Because both Roth IRA contributions are non-deductible, you generally do not have a tax liability for qualified distributions from an IRA. So like I said, it comes out tax-free because the money I put into it has already been taxed. It's not coming out of my paycheck before I pay taxes on it. It might come out of my paycheck after I pay taxes on it. It's included in taxable income. There are certain plans that can be allowed for that. But most of the time, this is just set up as a side thing with your bank or with your brokerage house. Qualified distribution is any payment or distribution that meets the following requirement. Number 1, Roth has been open 5 years. And I've reached the age of 59 and a half, or became disabled, or a beneficiary of my estate because I died, or I took out $10,000 to buy my first house. All those are reasons why I could take money out of a Roth and not pay taxes on it. Most common non-qualified distribution occurs when you're under 59 and a half when a distribution is made. For non-qualified distributions, use 8606 to determine the taxable amount. If a distribution is not qualified, if you receive it within the 5-year tax period, or if you withdraw excess contributions or earnings on it before the due date of your return, a 10% additional tax is imposed on premature taxable distributions. With Roth IRAs, you can always have your original contributions distributed tax-free, even if the distribution wasn't qualified. So as long as I leave whatever that was in there that it grew alone, then I can kind of skirt the whole excise penalty. Like I hinted at it before, there's something called the required minimum distribution. And like I said, this just means that they call it an overaccumulation. They want you to take some money out. And if you don't, they will charge you 50% tax on the money that you should have taken out. So they say you should have taken out $500, they're going to tax you $250. With employer plans mentioned above, you can't keep amounts in a traditional IRA indefinitely. Roth IRAs, you can leave it in there. You can be 90 years old, no problem. You can be 110, no problem. Dick Van Dyke can still have one. If you reach 73 and 224, that is the new age for required minimum distribution. It's up to the plan administrator to figure out. They will send them a letter, and you have all year to take out that amount of money. Well, I have money in my plan, and I want to take money out, whether it's because of a required minimum distribution or not, but I don't need it. So I want to donate to charity. Great. A qualified charitable distribution. Non-taxable distribution made directly by the trustee of your account, so whoever's keeping track of it, to an organization eligible to receive tax-free contributions, like the YMCA, a church, or something like that. Like I said, the important thing is to do this I can't receive the money. It's got to go straight from Merrill Lynch or whoever to the charity. That I can't receive it. Maximal exclusion, so the most I can contribute in 1 year is $105,000. If I have a spouse, they have their own $105,000 limit. If your IRA includes non-deductible contributions, distribution is first considered to be paid out of otherwise taxable income. So the money that you're taking out, they're going to look at it, money that's coming out as the one that would actually have been taxed. Qualified charitable distributions will count toward your requirement of minimum distribution. Cannot claim any charitable contribution deduction for any QCD not included in your income. Well, if I'm doing it right, my QCD shouldn't be included in my income. And so I won't be able to write it off on Schedule A as a charitable contribution. I already got my tax benefit from it. I didn't pay taxes on it to begin with. So I don't get the double count. Rollover. I don't like Merrill Lynch anymore. I want to put my money at Edward Jones. So I tell them, I call up Edward Jones and say, hey, I got a plan at Merrill Lynch. Here's the account number. I want to roll it over to you guys. And we go forward from there. So I'm transferring my money from Merrill Lynch to Edward Jones. The simplest rollover for the plan administrator of the old plan, to transfer the assets directly to the new plan. I don't have to pay taxes on it. I'm not subject to a penalty on it. It went from Merrill Lynch to Edward Jones directly. Didn't come to me at all. Great. Trustee to trustee rollover. No tax implications whatsoever. Sometimes if you change jobs, your retirement plan, hey, you don't work here anymore. Get rid of it. You're out. Take your money and go. Total distribution retirement fund may go to you, or you might be able to set up a transfer. Hopefully you can set up a transfer. When transferring retirement plan distribution, generally no taxes paid unless I've withdrawn it from the new plan or even from the old plan. If a check was cut out to me, I might have to pay tax on it. The total distribution retirement fund may be distributed to you. When transferring retirement plan distributions, generally no tax is paid until you withdraw it from the new plan. However, you choose to receive the distribution is taxable to you in the year that you receive it, unless you roll it over to a new plan or a traditional IRA within 60 days. This is an indirect rollover. I wasn't given the option of doing a plan-to-plan transfer. They cut me a check for the entire amount. I have 60 days to put it into an IRA and not have to include it in my income as taxable. Problem is that the original plan with administrator is required to withhold 20% of tax. And so to have a full rollover, I have to come up with that 20%. Knowing that I'm not going to I'll get this 20% back when I file my taxes, but right now, I got to come up with whatever that 20% withholdings was, or I don't have a full rollover. If I don't come up with that 20% and put it in, I'll have to pay tax on that 20%. And if I'm not 59 and a half, I'll have to pay another 10% tax on that amount. So don't do indirect rollovers. Never do a rollover where the check came to you. Always do a rollover from plan to plan. I can only make one indirect rollover from an IRA to another in any 12-month period, regardless of the amount of IRAs that are. Now, if I'm doing a plan to plan, I can do it every other week if I wanted to. But the indirect ones I can only do once a year. If you already made an IRA to IRA indirect rollover in the preceding 12 months, for each individual additional distribution you receive from an IRA of a previously untaxed amounts, I have to include those amounts in gross income. And if I'm not 59 and a half, I got to pay the extra 10% tax. So be careful. Again, this is kind of beyond the scope of a tax preparer. Yes, it's nice to know that way if it's happening to your client, you can explain what happened. But really, the first line of defense on this one was the plan administrators. They should have been keeping track of this. A traditional IRA can be converted to a Roth. That might be an idea. This is a taxable distribution, but it won't be subject to the additional 10% tax if I haven't reached age 59 and a half. So I want to have my traditional, say, nah, I want it to become a Roth. So I'll convert it. So I'll get a 1099-R, and it'll be coded box 2. It's an early distribution, but an exemption applies. The exemption was I'm rolling it over. I will have to pay tax on the distribution. Because remember, what's in the Roth? Money I've already paid tax on. What's in the traditional? Money I haven't paid taxes on. So to put it from the traditional to the Roth, I have to pay taxes on that money. And so that's going to happen here, the year that I convert it. Because IRA and other retirement accounts are tax favored, a means of saving for your retirement, rules limit the use of these assets. If you violate these rules, then you're subject to additional taxes in the rules in the year of the violation. 5329 is your form to keep track of all these punishments, shall we say, and maybe even the exemptions for it. So remember, 6% for putting in too much money, 10% for taking money out when I shouldn't have, and 50% tax for not taking money out when I should have. Alright, so generally early distributions are those you receive from a qualified retirement plan, deferred annuity, or contract, or IRA before you reach 59 and a half. Unless you qualify for an exemption, there's additional 10% tax on the taxable portion. The 10% additional tax does not apply to the non-taxable portion. And then we put in the tax amount, the additional tax from our 5329 online 8 of Schedule 2. So there are some exceptions to the 59 and a half rule. Keeping in mind that when we go over this list, we're basically going to be talking about traditional IRAs. We already talked about the exceptions for the Roth. They're not as many. Reason number 1, took money out of the plan because I was separated from service, but I'm not 59 and a half, but I actually am 55. So I was told to, you can't work here anymore for whatever reason. Take your plan and go. I can cash out, and I don't have to pay the extra 10% penalty because I'm 50. Distributions are part of substantially equal periodic payments for the rest of your life. I have money in an IRA, and I have a terminal diagnosis. Well, I don't need the IRA anymore, do I? So if I start taking out, payments for whatever reason, I don't have to pay the 10% excise tax on it because I don't need to save it for my old age. I ain't getting there. Reason number 3, took the money out because I became totally and permanently disabled. Well, there's a good reason to have the money. 4, distribution due to death. Well, let's see here. Taking money out of a plan from a guy that doesn't need it anymore. Yeah, no 10% excise tax. Qualified retirement distributions to the amount you paid for unreimbursed medical expenses during the year, more than 7.5% of your adjusted gross income. I'm using money out of my retirement plan to pay for medical bills. That's a reason that I don't have to pay the extra 10% tax, but I have to have bills um, higher, or how do I say this? The total amount of bills that I'm being paid, I'd have to pay a extra tax on it for the first 7.5% of my adjusted gross income. So if I made $10,000, I have to have $7,500 of, or $750. Sorry, my bad, of medical bills before I reach that exemption. Reason number 6, plan distributions made to an alternate payee under a qualified domestic relations order. Divorced. Judge said some of that money is in that account is hers. She gets it. All right, well, I don't have to pay excise tax on that. Reason number 7, certain unemployed unemployed individuals so they can buy health insurance. Reason number 8, higher education expenses. Use it to pay to go to college, VOTEC. That will be for you or some dependent listed on your return or your spouse. This is the one that's traditional and Roth. Buying a first-time home, I could take up to $10,000 without having to pay the excise tax. I could take money on my retirement plan and not pay an extra 10% tax on it because the IRS needs the money. I owe the IRS a boatload of money, and one way I can pay them off is to cash in my IRA. Yeah, I'll still have to pay I'll have to pay regular income tax, but I'm not subject to the 10% extra tax. Reason number 11, reservist that's been on active duty for at least 180 days. Things might be a little tight at home because the Army doesn't pay as well as whatever their regular job is, and so we need the money to keep the lights on. That's that, and they're in the Guard or they're reservists and they're on active duty. We could take it out and not pay. One thing that's missing on this list, unfortunately, is Joe Blow, just a regular guy, taking money out because he wanted to pay the mortgage. Yep, that's not an exemption. Like I said, 5329 is a big form that covers all the extra taxes, and it also covers the exemptions from those taxes. So elected deferrals to qualified retirement plans are not included in wages, subject to income tax, called before tax contributions. I can put up to $7,000 or $8,000 if I'm 50 or older into a plan. If I earned income, I could contribute to a traditional IRA for a spouse who didn't have any, and combined we could put in 14 or, depending on our age, more. I could put into Roth at any age, but I still have to have taxable income. Taxable IRA is entered in 4B of your 1040. Pension annuity income is on 5B. If I'm doing an indirect rollover, I have 60 days to pull it off. If not, I am subject to the extra 10% excise tax if I'm not 59 and a half. If 2A on my 1099-R is blank, I can't just leave it at that. I gotta have to find out why, and it might be a legitimate reason. Pension and annuity distributions have a tax-free portion if you made after-tax contributions to the plan. I didn't cover that in the scope of this class. It's just not part of what I consider a rapid class. Go back and refer to the watch the basic class. Money can be left in a Roth IRA until the original owner dies. You may be subject to additional tax for contributing more to a traditional IRA than or Roth than you're allowed to. That's extra 6% tax. Or you may be subject to additional tax for not taking enough money out if you're over 73, or you took any money out for no good reason and you haven't reached 59 and a half. All right, so that's one chapter. Let's talk about this next chapter. Let's take a 5-minute break, and then we'll talk about this chapter. We'll be back in 5. So, next chapter we're going to talk about is chapter 7. I've edited this down some. There was some information in here that I felt was beyond the scope of a rapid class, so I've edited this down to focus on Schedule A, itemized deductions. Because we've talked about standard deduction, and I don't see a lot of need to talk about income tax itself. It's just something the program handles for you in the background. It just talks about how to read the tax tables, which you never will, or how to use the tax formula, which again you never will. So, I mean, that's the whole reason why we have the program, to take care of some of that trivial stuff. So, we're going to talk about itemized deductions on Schedule A. I might have left one slide in about the capital gains. No, I think I took it out. My bad. So, we're going to talk about the various categories of the itemized deductions and how to work on Schedule A. Most taxpayers have a choice of taking standard deduction or itemizing their deductions. Itemized deductions are eligible expenses that you can claim on your tax return to decrease your taxable income. The most common reason for itemizing is home ownership, because home mortgage interest is tax deductible, and so is the real estate taxes that you paid on your home. That's also tax deductible. There are some other common itemized deductions that are large reimbursed medical expenses. Those are tax deductible. State and local income tax or state and local sales tax. One or the other, not both. And charitable contributions are the most common other reasons for having itemized deductions using Schedule A. So after computing your adjusted gross income, we arrive at taxable income. And then we're here at line 12, standard deduction or itemized deductions from Schedule A. And of course, we have our standard deductions for whatever they are for the year. And of course, remembering that if you're married filing separately and your spouse itemized, you must itemize. You don't get a standard deduction. But there's one more class that I want to talk about here before I move on into Schedule A, is that there are certain religious sects that by church doctrine aren't allowed to take the standard deduction. That's considered a government handout. The rules of the church says no government handouts, you don't do it. Leave Caesar unto what is Caesar's. And so they automatically have to itemize due to church doctrine, which is fine. There's a box on there, infusion, and then we go out and fill Schedule A, and we hope it's to their advantage. I mean, if there's nothing wrong with them going over as far as the church is concerned, if they're married and they're, and they have $40,000 of deductions, we can take all 40. That's not a problem as far as the church is concerned, because that's money that they paid. They're just not allowed to take the standard deduction. So, and if it's only $5,000, well, that's what they get. The other person that can't take a standard deduction is non-resident aliens filing a U.S. tax return. Again, they only get what they get off of Schedule A. So, here's what our Schedule A looks like. It's pretty straightforward. Itemized deductions. These are medical expenses. We're going to talk about medical and dental expenses, certain state and local taxes, certain interest expenses, gifts to charity. I took out the casualty losses. It's just a rare thing, because to be able to write it off, you have to live in a federally declared disaster area before you can even consider doing anything. And so if you need it, go back and look at it. It's in my basic class. Again, I feel that this was beyond the scope of a rapid class. It is in the basic class. I covered it. Other itemized deductions, we're not going to go into a lot of details, but this is, for instance, this is where you'd put your gambling losses up to the extent of your winnings, now knowing that it's limited to 60%. We need to, for itemized deductions, we're saying we actually spent this money. So we need good record keeping. We need receipts. We need logs. We need canceled checks, credit card statements, whatever it takes to prove that we actually spent the money. When itemizing, write off everything you can that's allowed by law. I mean, that's the whole idea about itemized deductions. I'm trying to lower my taxable income. Hopefully by an entire tax bracket. If you get to choose between standard and itemized, you should take the method which gives you the best refund. It's your choice. So let's talk about the first part of Schedule A. You can deduct only the amount of unreimbursed medical and dental expenses that exceeds the applicable percentage of your adjusted gross income, which right now is 7.5%. So again, if I was making $1,000, I'd have to have medical bills up to $750, and I could start deducting the first dollar after that. Deductible medical and dental expenses include the cost of diagnosis, cure, treatment, prevention of disease, including health insurance premiums for medical care, dental care, including qualified long-term care insurance. This includes Medicaid Part B and Part D. So when you look at your SSA 1099 and you see Medicare payments and you plug it into Fusion the way that you should, it automatically is being carried back to Schedule A. Go ahead and fill out Schedule A. Put all that stuff in there. I learned, fill it out. This is the reason why you want to fill it out, because maybe it won't work on the federal side, but it might work on the state side. So go ahead and fill out all you can. You never know. Hey, maybe you beat the standard deduction this year. If you beat it, then great. And if you don't, if Fusion will ignore it. If it doesn't beat the standard deduction, it won't use it unless you specifically force it to. Alright, other medical expenses I could write off. The cost that I paid for prescription medicine. The cost that I paid to go see the doctor. The cost I paid for lab fees, x-rays, CAT scans. If I paid for Cologuard out of pocket, I get to write that off. Go to the hospital, I get to write off the services. I don't get to write off the food, unfortunately. Stop smoking programs, I get to write it off. Medical treatment at Center for Drug and Alcohol Addiction. If you go to the Betty Ford Clinic, hey, you can write that off. Like I said, I can't write off until I exceed 7.5% of my adjusted gross income. You can include medical expenses you pay for yourself, your spouse, if married filing jointly, dependents who claim on your return, a person who was your dependent at the time you paid the expenses or at the time the medical service was provided, any person that you could have claimed as a dependent except that they went over the limit to be considered a qualifying relative. So kind of a little bit wide open here about expenses of who I paid it for, but basically anybody who's listed on your tax return and I'm paying expenses for them, I can write those expenses off. For divorced or separated parents, if either parent can claim the child as a dependent, each parent can include the medical expenses they paid for the child, even if it's not listed on the child's not listed on their return. If they paid medical expenses, they can write it off. Doesn't matter which parent claimed the child. If they're filing separate returns, each of them can only include the medical expenses they paid. Any of the expenses that are paid out of a joint checking account, which they have a share of the ownership, the expenses will be considered to have paid equally by both unless they can prove otherwise. And of course, we have our community property states that's going to be considered equal. Let's see here. Deductible medical and dental expenses include the cost of diagnosis, cure, treatment, or prevention of disease, including, hey, that could be that doctor copay. It's just as simple as that. You went to Walmart and paid for a flu shot, I get to write it off. Weight loss programs, if the treatment is for a specific disease, including obesity, as diagnosed by a doctor. I just can't decide that I'm fat and sign up for a weight loss program and write it off. No, I have to have the doctor tell me that I'm fat and say, you need to lose some weight. Go sign up for this weight loss program. Get a doctor's note. Medical aids. So, bought eyeglasses, contact lens, hearing aids, crutches, wheelchairs. I could write all that off. And let's not forget about the things that make it work. So, hearing aids. Let's not overlook the cost of the batteries. I can write that off too. Hearing aids are useless without the battery. Guide dogs, including the cost of maintaining them. So you got a guide dog, one of those dogs that, barks when the doors open or the doorbell goes off for the deaf people, or, detects that you're about to have a seizure. Any of those things, as long as they have the appropriate documentation that they've gone through a class, gone through a school. If you have that, then you can write off the cost of all sorts of things. Going to the vet, getting a rabies shot, getting a parvo shot, grooming, Alpo, dog chow, flea collar, all of that. Including the cost of the training program. Lodging expenses, but not meals, because no matter where I'm at, I've got to eat, so I don't get to write off meals. While away from home to receive medical treatment provided by a physician, providing that there's no significant element of personal pleasure, recreation, or vacation in the travel. The deduction for lodging expenses is limited to $50 per night. So we're not talking about being able to write off staying at the Ritz-Carlton. We're talking about Motel 6. And you can stay wherever you want, but you're only going to be able to write off $50 a day for lodging. Let's go back and look at no significant element of personal pleasure recreation. The whole reason why I'm in town is because I have to see a specialist or the doctor, whatever. But I'm going to see a doctor, and that's basically the reason why I'm in town. Doesn't mean I can't have a little fun, but the whole reason for me being in town is to go to the doctor. And the fact that I was able to go off and, go to the mall or something like that, that's secondary for my reason for being in town. I can write off the cost of ambulance services. If you use your car for transportation, I can deduct mileage for the medical mileage rate to and from. So round trip. And that's to the doctor. Or to the eyeglass place, to the hearing aid place, dialysis place. I went to Walgreens to pick up prescriptions. I went to Walmart to pick up hearing aid batteries. All of those are miles that I can write off. Round trip. You may also add any costs, so write off any costs for parking and highway tolls. Expenses that are beneficial just to general health, such as vitamins, vacations, can't write that off. In addition to non-prescription medicine, I can't write off aspirin. Advil, nope, sorry. Tylenol, can't write that off. Vitamin C, can't write that off. Unless I have a doctor's note saying I have to take the vitamin C. Or I have to, whatever the reason is. Because that became a prescription. Can't write off diet food. bought some Jenny Craig. Sorry. Can't write off cosmetic surgery unless it's medically necessary. I just can't look in the mirror again and say, well, hey, I look ugly. I'm going to get some Botox in my forehead. No, I'm not going to be able to write that off. Now, you have, for instance, a woman who might be inclined to get breast cancer. It has the gene. So we'll read that off at the pass. I'll have my breasts removed so we don't have to worry about it anymore. That's cosmetic surgery, yes, but it's covered because that's deemed medically necessary. You had your breasts taken off. You want to have some cosmetic surgery to make it look a little bit more presentable. Again, that's cosmetic surgery, yes, but that's also medically necessary. That's covered. So just because it's cosmetic surgery does not necessarily mean it's not covered, unless, like I said, had to be medically necessary. Life insurance premiums are not deductible. Medicare taxes withheld on your W-2, not deductible. Funeral costs, not deductible. Add all of this up. Schedule A line 1, and the allowable amount will be on line 4. But we're not quite done yet, so let's continue talking about transportation. Expenses include primarily and essential to medical care are deductible. You can deduct the cost of travel to your doctor or medical clinic for treatment. To and from. It does you no good to get to the doctor without being able to go home. May claim the standard mileage rate, 21 cents a mile currently. Always look to see if it's changed. Or the actual out-of-pocket expenses such as gas and oil. Don't like that. I hate using that because, are you really going to use up an entire tank of gas to go see the doctor? So don't plop down, hey, I went to the doctor this day and this is how much gas I put in my tank. No, that doesn't work for me. I can't prove that you used the entire tank. Cost of tolls and parking fees can be deducted whether you use the standard mileage rate or actual expenses. Have a breakdown? Sorry, can't help you on that one. Other transportation expenses that can be deducted are bus, taxi, train, and plane, or ambulance services. Transportation expenses of a parent to accompany a child who requires medical care are deductible, as well as the transportation expenses of a companion traveling with the patient who is unable to make a medical trip alone. Transportation expenses that are merely for the general improvement of one's health and travel for purely personal reasons to another city for an operation or other medical care are not deductible. So let's analyze this just a little bit because it's saying a lot. I'll focus on this paragraph right here at the moment. We'll talk about the other one also, but I'll focus on this one right here. Okay, I need to go see a doctor, but hey, I think I found a way around it. I can write off going to New York City. Yeah, man, I write off my plane fare to go see a doctor in New York City. I'm just going to see a general practitioner. Well, you can get that in your town. So, no, that's not going to be allowed. That's going to be thrown out. Now, if you have a recommendation to go to another town to see a doctor from your local doctor, whole other thing. I have a client who has to see a specialist at the Mayo Clinic in Rochester, Minnesota. She lives here in Wichita. So let's talk about transportation expenses that she can write off. She's at home and she needs to get to Rochester. She's going to take a plane. So what can I start writing off? Well, I can write off the medical miles as medical miles, the cost of driving her car, the mileage, to the airport from her house, or the cost of a taxi, the cost of an Uber, Lyft, what have you. She takes her car, parks it. I can also deduct the cost of the parking. Husband takes her to the airport, drops her off. I can still write off the miles. She gets on the plane. I can write off the plane fare, including any money that's paid out for checked baggage. Gets a drink on the plane. Sorry, can't help you. Buys a bag of nuts. So can't help you there. Flies to Minneapolis because that's the closest airport, basically, with regular service that's easy to get to. All right, so she's in Minneapolis, and she's got to get down to Rochester, Minnesota, which is an easy drive, about an hour and a half on 4-lane road, no problem. Well, maybe I'll take a bus. Maybe I'll rent a car. Well, I could rent, obviously I could write off the cost of the bus. Rent a car, I get to write off the cost of renting the car, plus the mileage that it takes me to drive down to Rochester. And of course, she's in Rochester. She's not going to be home anytime soon. Hotel, $50 a night. And of course, when she gets done seeing the doctor at the Mayo Clinic, she's got to go back home to Wichita, so I get to take all those expenses again in reverse. Alright, so let's go back up to this one. Transportation expenses of a companion traveling with a patient unable to make the medical trip alone. Let's not just, the child is the one that comes to mind, but let's just not leave it at that. If my client from my first example has any time where she is in such a state that she's not capable of making a medical decision for herself, I can include the cost of her medical proxy to accompany her on this trip. It's a lot easier when you're doing it with a child. Yes, I understand that. It's a less of an argument. But again, there's also places where, yes, we need to have somebody on hand who has the power to make a decision when our patient is incapable of making one. And so therefore, I will take the expenses if her husband had to go because she was going to be medically incapable of making a decision at some point. So he went along. Yeah, I have no problem taking all of those same expenses that I just talked about. No problem taking it for him too. And by the way, that $50 a day is now $100. It's $50 each. The cost of lodging at a hospital or similar institution is deductible if the main reason for being there is you're getting medical care. Which, if I'm in the hospital, that's the main reason for being there, so that's not a problem. You can deduct the cost of lodging not provided by a medical facility if you meet all the following requirements. The lodging is primarily for and essential to medical care. Medical care is provided by a doctor in a licensed medical care facility. The lodging is not extravagant. There is no significant element of personal pleasure, recreation, or vacation in the travel time away from home. The amount you include in medical expenses for lodging cannot be more than $50 for each night for each person. The cost of lodging for the person accompanying the patient is deductible, just like we said in the previous extension. And let's keep in mind about our whole trip, we're talking about no significant element. My client who went to Rochester, guess what's basically right across the street, more or less, from Minneapolis-St. Paul Airport, the Mall of America. So, if she decides to take a trip off, or take some time off and go to the mall, walk around, it's not a problem. If she takes an entire day, yeah, I'm not going to count her, at least I'm not going to count the day's lodging for that. If she stays overnight in Minneapolis, or in this case, Bloomington. Yeah, no, I'm not going to do that. That's kind of pushing it. So, but just the fact that she went there, walked around for a couple hours, that's not significant. So I have no problem with that. The full cost for you, your spouse, or your dependent to live in a retirement or nursing home is deductible if the reason for being there is primarily because the availability of medical care. You cannot not deduct these expenses if the principal reason for you living at the facility is just personal. And you could have a case of this, is that I've seen this. They live at an assisted living facility because one of them has a medical condition, they're married, and so the other one just moved in just to be there. Well, I can write off the expenses for the one who needs the medical care. The other one who chooses to live there just for convenience sake, I can't write off his expenses for the living facility. I can still write off medical expenses for all of them, but the cost of actually living at this assisted living apartment, I can only deduct those expenses that I could attribute to the one who actually needs to be there. Home improvements that do not increase the value of the home but are required to a medical condition are deductible. If the improvements increase the value of the home, only the amount over the increase of the value is deductible. So I had a client. This is back when I was going to the client's houses to do taxes, or before I worked for Liberty. New house for the client this year, so I was looking around, just sitting, doing taxes at the kitchen table, and noticed the hardwood floors everywhere. It's like, oh, hey, this is a brand new house. Hardwood floors, you don't see that very often. You see carpet all over the place. The guy tells me, well, yeah, it did have carpet. I had to rip it all out because I have severe asthma, and the doctor told me to get rid of the carpet. Put in hardwood floor. Oh, yeah? Can you get a doctor's note for that? Well, yeah, I can get a doctor's note for that. Great. I wrote off the cost of his floor because the doctor told him he can't have carpet. Did it increase the value of the house? Not significantly, so I wasn't worried about that part. He took out perfectly brand new carpet and replaced it with a hardwood floor. So, the way I see it, that was net sum zero. But I originally lived in Minnesota, and at one time, while I was living there, it wasn't necessarily common to have air conditioning. Let's face it, when you live that far north, yeah, there's some uncomfortable days, but few and far between. Probably not worth the cost of air conditioning, at least at the time that was going on. Obviously it's cheaper now. You can find air conditioning all over the place. But somebody with COPD, with severe asthma, again, can't, humid, really humid up there. Well, it can be so humid it makes it hard to breathe. So we need to install air conditioning at your house, says the doctor, so it dries out the air so you can breathe. Install air conditioning. Again, I can write off the cost of the air conditioner, the cost of the wiring, the guy that installed it, all of those expenses, every last penny involved into buying and installing and getting the air conditioning to a running state. I can deduct all of it after I make an adjustment for the increase in value of the home. Because it has air conditioning now, it didn't before. That's going to increase the value of the home. I need to get an appraisal to find out how much the increase was. So if it increased the value of the home by $1,000 and the guy spent $1,700 to put it in, I can write off $700. An insurance premium for policies that you pay to cover medical care are deductible for out-of-pocket expenses, not that double D you see on the W-2. You didn't pay for that. Policies can provide payment for medical and dental expenses, prescription drugs, eyeglasses, replacement of contact lenses. So here's an example of coming back to this. We buy up on our dental expenses. It costs us an extra $100. That's out of our pocket. Extra $100 a month. I can write that off. Medicare Part B payments from a SSA 1099. Voluntary prescription drug insurance program, Medicare Part D. Again, that shows up in SSA 1099. As soon as I fill out my SSA 1099 infusion, those numbers are automatically carried back to Schedule A. Premiums for long-term care insurance can be deducted on Schedule A. They are subject to the limitations based on the age of the insured. Medical insurance premiums paid with pre-tax dollars or reimbursed by an insurance company are not deductible. Even if I paid out of pocket and I'm expecting to get paid back, I can't write it off because I'm expected to be made whole again. Now, if I get a letter from the from the insurance company says, yeah, no, we're not approving this cost, You're going to pay for it. Well, okay, then I can write it off. Amounts that you pay for participation in a weight loss program as a treatment for a specific disease, including obesity, diagnosed by a physician, are deductible medical expenses. Diet food items aren't deductible. The IRS views diet foods, even when used as part of the weight loss program, as substitutes for food that you would normally eat. So you're going to eat, it doesn't matter. Eating is eating, you're not going to deduct it, even though you're paying a premium price for it. Weight loss programs to improve your general health appearance do not qualify or are not regarded as deductible personal expenses. Like I said, it's not enough for you to just decide that you're fat. You got to have the doctor tell you need to lose some weight. Stop smoking programs. I can write off the cost of a program, but I cannot write off the cost paid for drugs that did not require a prescription, like nicotine gum or just stop smoking patches that are available over the counter. Now, if I'm getting the good stuff from behind the counter, I can write that off. Like I said, if I'm expecting to be reimbursed by the medical company, by the insurance company, for money that I've already paid out of pocket, don't write that off. Only when I have reached a reasonable expectation time of not being paid back can I include it as expenses. Generally, medical expenses are not reduced by payments received for permanent loss of a member or function of the body, or disfigurement to the extent the payment is based on the nature of the injury without regard to the amount of time lost from work or loss of earnings. Reduce the medical expenses by any part of these payments that are designed for medical costs. So if we're receiving other reimbursements, like for instance payments from Aflac, that's outside of the scope of this kind of. But if it's a big medical payment and it might cover the cost of a limb, I have to adjust for it. Let's see here. Did I cover everything that I wanted to on medical? There's a lot of leeway in medical. There's a lot of gray area in medical. So if you got something you got a question on, run it by me and we'll talk about it. A little bit more solid: taxes that I've paid, for them to be deductible, it must be a tax that is my tax imposed on me, and it must be a tax that I paid. Obviously. Could be state and local taxes, could be state and local income tax, or state and local sales tax, but not both. State and local real estate taxes, personal property taxes, paid for your car, for instance, your snowmobile, your boat. All of those could be under property tax. Excuse me. So you could elect to deduct either state and local income tax or state and local general sales tax, but not both. And obviously there are 5 states where there's no state and local income tax, so to take a tax deduction, they will use the general sales tax. And keeping in mind, if I'm writing off state and local income taxes withheld, if I get a refund when I get that 1099-G next year, I have to include that 1099-G in taxable income. So state and local income tax includes money that was withheld from my paycheck, or estimated payments that I might have made to the state, or balance that I paid to the state because I owed taxes last year and I paid it this year. Looking at a W-2, box 17, box 19 cover the area that we're focusing in on right now. Other forms like a W-2G, 1099-R, 1099-G also they have boxes for it. They may or may not have entries in them. As an employee, you can deduct mandatory contributions to the state benefit funds withheld from your wages that protect against the loss of wages. So, for example, certain states require employees to make contributions to state funds providing disability or unemployment insurance benefits. California is a great example of a state that does that. They have all sorts of things that could be included as a state and local tax that I can write off on Schedule A. General sales tax, I can use the actual taxes I paid or the amount using the tax table. I will tell you that the tax table is terrible. So if you're going to do sales tax, I recommend that you use your actual receipts because it'll be better. State taxes on motor vehicles are also deductible as general sales tax. So if I bought a car, I could write off the taxes that I paid on that car. To use the actual expense method, you must keep the actual receipts. Keep the receipt you got from Walmart, from Walgreens, from Dollar General, all of those. Add them all up. Or you can use the optional tax tables. The IRS makes a tax table that covers the state, and then inside the state section are the counties that allow, so it can show you down to like Sedgwick County here. They show you that there's an additional 1% tax. But let's not overlook the fact that some municipalities inside Sedgwick County, like Derby, like Goddard, like Park City, all charge and Wichita, all charge an additional 1% tax, sales tax. So don't forget to add those in. There is a worksheet that is available for you where you plug in the base number off of the tax table and then add a number to represent the county sales tax, and then add another number to represent the local sales tax. So we have Marissa lives in Montgomery, Alabama. She made $35,498. Did not purchase anything extra because regardless of which rate I use, if I use the tax table and I buy these items here, I can add them to the number off of the tax table. But since she didn't buy any, we're stuck with what we got on the tax table. And here's what we got. She lives in Alabama. And then we look down in here. Okay, I forgot it doesn't break down by county, but the worksheet does. She made $34,900. You run to the table, it covers that area. Her family size is just her. Her sales tax deduction is a whole $446. Woohoo! I told you that the table is terrible. If you could do actual expenses, it's better. But 446 is the number she's going to run back to her Schedule A as an itemized deduction for state sales tax paid. Like I said, if you live in areas that also have an additional tax, this worksheet covers that. Your base local tax, local general sales tax, all of those things get accounted for. So it helps. Again, though, if I'm using actual sales tax as opposed to the table, then if I'm using actual, then I'm not worried about this worksheet either. Deductible real estate taxes are any state and local tax on real property levied for public welfare. These are taxes on all real property that you own, house, land, etc. that's not used for business. If you use it for business, you'd write it off on Schedule C, not Schedule A. They must be paid based on the assessed value of property and are deductible when paid. Real estate taxes are frequently reported on 1098, which is the mortgage interest statement. I love seeing 1098s because, like I said, I've got all sorts of information on there that I can use on my Schedule A. I have my my real estate taxes paid. I have my Home mortgage interest paid. And another thing that's deductible that we haven't talked about yet, but is deductible, that'll be on the 1098. If they are subject to private mortgage insurance, PMI, that's also deductible. So if they're subject to that, I can write that off too, and it's on the 1098. That's my receipt. That's all I need. Personal property taxes are based on the value of the thing that's being taxed. Example of personal property taxes based on the value of its car or boat. I can write off the tax. Just the tax. Vehicle registration fees on a vehicle, do it by weight, then value. I can't deduct that. Most states do it by value, so I'm not worried about that aspect of it. But let's go back to just the tax end. And I don't care how much you paid the Sedgwick County Treasurer when you went to renew your car tag. I don't want the canceled check. That's not the amount. That amount includes the fees on the fees to cover the fees, to make the fees. No. I only get to write off the tax. Go out to your glove box and bring me back the sheet that the piece of paper that the license plate tab was on, so I can look at the itemized part and pick up the tax. We're limited to $10,000. We're taxed on our worldwide income. If we have taxes paid on our income and we pay tax to a foreign country based on our income, then I can write it off on Schedule A, perhaps, or there's another option where I could take it as a tax credit and fill out Form 1116. Either way. But again, when I'm writing off foreign income taxes, it must be taxes levied against income earned in that country. So I can do this for my Canadians. That's pretty straightforward. They have a tax system that's very similar to ours. On their T4s, they're right. The boxes are right there. I have no problem. My guy who lives in the United Arab Emirates, they don't have income tax, so he doesn't qualify for any of this because he doesn't pay taxes on anything to the Emirates. And an example of a foreign tax that's also not deductible in France. I took an IRS webinar on this. French taxes aren't deductible because the French taxes aren't based on your income, they're based on your net worth. And since that's not an income tax, you don't get to write it off. Some other taxes, whether or not I can or might not deduct, I can deduct fees and charges that are well, let's see here. That would be Schedule C. I don't like that. Foreign and local income taxes, state and local income taxes, general sales taxes, maybe, whichever one of these. Taxes that are expensive for your trade or business, well, again, that's going to be Schedule C. Taxes on property producing rent or royalty income, that's not Schedule A either. That's going to go on Schedule E. 1/2 of self-employment tax paid, that's not a Schedule A item. That's an adjustment to income. Well, I don't like this table at all. Personal property taxes I can write off. Real estate taxes I can write off. Some other things that are generally not deductible in Schedule A include federal taxes like income tax, Social Security tax. Can't write that off. Marriage, drivers, hunting pet licenses, sewer and water taxes, taxes on booze, taxes on gasoline, self-employment tax, utility taxes, fines or penalties. None of those are deductible on Schedule A. Can't deduct homeowners association charges, transfer taxes, or other taxes charged on the sale of a personal home, or taxes for local benefits that tend to increase the value of the property. So, like, I can't deduct the value of specials because a special tax was assessed on me because they put in a new sidewalk. Well, no, that increased the value of the property. So theoretically, I'm not allowed to deduct that on Schedule A. Interest paid. Interest is the amount paid for the use of borrowed money. Personal interest is not deductible. Now, not this. Excuse me. Car loans now is deductible according to OB3. Up to $6,000 on a new car manufactured or where the final assembly was in the United States. Still can't deduct credit card interest or any loan fees. Deductible interest on lines 8 and 9 of Schedule A. I could deduct home interest and investment interest. I'm not going to talk about investor interest. It's beyond the scope of a rapid class. Car loans, I believe, is going to show up back here. And since it happened later in the year, at this time the IRS does not have an official form for it. And so we're hoping that the bank that's holding the car loan will send out a letter saying, okay, you paid. Because remember, when you make a payment, not all of it is interest. Some of it's principal. So we're going to need to have a letter from the loan company saying this much of the payment, total payments for the year, was for interest, and this much of the total payments was for principal. You deduct your home mortgage interest only if the mortgage is a secured debt, which most of them are, so I'm not worried about that. You can deduct your home mortgage interest only if the mortgage is secured by your qualified home, which is your main home or your second home. It could be a house, condo, cooperative, mobile home, boat, or similar property. All of that we have to have in common for interest on this item to be able to be deductible for a home mortgage is that it has basic living accommodations, including a place to go to sleep, a place to cook, and a place to go to the toilet. And in regards to the boat, we're not referring to over the side. You can only deduct your home mortgage interest only if the mortgage is home acquisition debt. If I take out a mortgage so I can remodel my house, that's not deductible. Home equity loans, not deductible. Cannot deduct payments I made for somebody else if I'm not legally liable to make them. So if I paid mom's mortgage, I can't write off the fact that I paid mom's mortgage. It's not my mortgage. It's not my house. Now, if I'm on the deed, if I'm on the note, if I'm responsible, if she goes in arrears, now I can write it off. But the other thing is that nobody's going to stop mom from writing off the payment because the bank isn't going to make any differentiation. They're going to send out the 1098 to mom. Of course, chances of her needing to file a Schedule A are pretty slim anyway. Like I said, you receive a 1098. Hopefully the bank does that. Sometimes you gotta pull teeth. Bank of America is very bad about sending out 1098s. You have to beg for them. And even at that, they'll probably just send an email, which is fine. I don't care. I mean, I love email. That works for me too. A 1098, like I said, has all sorts of information on it. Mortgage interest received, also mortgage insurance premiums, that's deductible. Points paid, that's deductible. So of this form already, box 1, 5, and 6 are all deductible. And then also usually down in this area, as a side note, sometimes it's up here, but usually it's outside of this, you'll find real estate taxes paid. That's also deductible. That's my receipt. if you are paying home mortgage interest from somebody that you're buying the house from, that they're the one holding the note, it's not going to the bank. When I write off that interest that I paid to the guy, I've got to put down the person's name and social security number and address of the person who I paid the interest to. Because guess why? They're going to check to make sure that that person reported it as income. Let's see. For a limit, there are limits on some of these. So if you've taken it on or before December 15th of 2017, up to or I'm capped. There's a different cap for before or no, October 13th of 1987. So there are some caps for most of our clients, really not in play. Now, if you lived in California, a whole other story. Points, I told you before that you can write them off because it's prepaid interest. 1 point usually is 1%. So I can maybe lower my payment right now by making buying some points in advance. That actually helped lower my monthly payment. Gifts to charity. Charitable contribution is a donation to a qualified organization. It is voluntary. It is made without the expecting of getting anything in return. And if I did get something in return, I have to subtract the value of the thing I got back from the amount of the money that I donated. Could be cash, could be goods, could be services, but I can't write off the value of my time. You know, a doctor donates his time to Hunter Clinic to see the poor. He can't write off his time. Cash contributions go line 11 cannot in general exceed 60% of your adjusted gross income. But if it does, it just rolls over to the next year for up to 5 years. You can deduct contributions only if made to a qualified organization like churches, federal, state, and local governments, and other organizations that have been approved by the IRS. They have a 504c3, I believe, is the paperwork for that. Let's see here. Organizations do not qualify, include ones where contributions only benefit the individual group and not the greater society. That's up to the IRS. Cost of a raffle ticket is not deductible as a charitable contribution, even if the ticket is sold by a nonprofit. That's you're getting something in return. You got the ticket, which you could benefit. However, if I lose, I might be able to write it off as a gambling loss. Deductible items include money, of course, dues, fees, assessments paid to qualified organizations above the value of the benefits received. So maybe I bought dues and fees for somebody else to be a member. The donation of used clothing, furniture at a fair market value. We're talking thrift shop value. Basically, what they're going to sell it for. I'll go ahead with it now. You know, Brenda had a lady. She donated Calvin Klein jeans. You know, brand name, never even worn them, brand new. I want to write off. They sell for $150 a pair. I want to write off $150 for each pair that I gave. No, you can't do that. You get to write off the thrift shop value of blue jeans, $5. The cost and upkeep of uniforms worn while performing donated services, but not for general use. Band uniform, for instance. Unreimbursed transportation expenses related directly to the services you gave a qualified organization, including bus tolls, parking fees, either the actual cost of gas and oil. Again, I'm not a big fan of that. Proved to me that, okay, I filled it up at the end of the day, or at the beginning of the day, I used up all that just for donations. No. 14 cents a mile. I like that a lot better. If you gift $250 or more, I have to have a statement from, at any one time, by the way. I have a statement from the organization showing the amount of the gift and the description of any goods or services provided in return for the gift. You do not have to aggregate separate donations to determine the 250 threshold. So the fact is, I gave $50 a week to the church. That's $2,500 for the entire year. I don't have to have this detail up here because none of those gifts were $250 or more. Now, I'll still get a statement, most likely from the church, saying that that's what they donated to church. There'll probably be one. Usually a tithing statement is issued. And that's your receipt. I'm good with that. Charitable contributions. Money or property you give to churches, synagogues, temples, mosques, other religious organizations, federal, state, local governments, if it's for the public, non-profit schools and hospitals, the Salvation Army, Red Cross, Goodwill, United Way, Boy Scouts, Girl Scouts, Boys and Girls Clubs, war veterans groups, expenses paid for a student who lives with you that's being sponsored by a qualified organization, out-of-pocket expenses where you serve an organization as a qualified volunteer. All of those things are deductible. Money that's not deductible, money that I gave to civic leagues, social sports clubs, labor unions, Chamber of Commerce, foreign organizations except for the Canadian, Israeli, and Mexican charities, groups that are run for personal profit, groups whose purpose is to lobby law for changes so you can't write off your donation to the NRA, not homeowners associations. You give some bum on the street $20, can't write it off. Can't write off the fact that you were trying to buy a public official. Can't write off the cost of raffle or bingo or lottery tickets, but we saw that I could actually put them down on gambling losses. Dues, fees, bills paid to country clubs, lodges, fraternal orders, or similar groups. Tuitions, the value of my time, or the value of blood given to blood bank. I can't write any of that off. Property, I can deduct generally the fair market value of the property that I gave. The fair market value is the price at which the property would change hand between a willing buyer and a willing seller, neither one of them having a gun held to their head, and everybody knows all the facts. Fair market value is determined on the date of the gift. Usually, there are penalties for overstating the value, so it'd be nice to have an actual official statement, appraisal, something. A lot of people donate cars. Hey, I'm good with Kelley Blue Book at that point, but a lot of times, what happens on the cars that we'll find out here in a second, if I didn't delete the slide, the charitable organization takes the car, takes it down to the auto auction. Whatever it sells for, they'll issue you a 1099 back at you saying, hey, thanks for the car. We sold it for this. That's the amount of your deduction. Used clothing, appliances, furniture, books are examples of items that are usually worth only a fraction of what was originally paid for them. Like I said, those jeans. I don't care that you paid $150 a pair. They were $5. Deduction cannot be claimed for clothing or household items that are donated unless the clothing or household items are in good, used condition or better. So I don't get to write off the fact that I threw all my junk in a bag and I dropped it off at Goodwill. Yeah, no, that doesn't work. If you donate more than $500, I have to fill out a Form 8332 explaining everything that I gave, what was in that bag, an itemized list, and the value thereof. If I go over 5,000, if the donated item is worth more than $5,000, I need an official appraisal from an independent third party. Like I said, if a lot of people donate a car, So they're going to get a 1098C. Now, if they keep the car, like I donated a four-wheel drive to Meals on Wheels, and they decided, hey, it's pretty good condition, I think we should keep the car and use it for bad weather. So they're not going to go to auction and get a 1098C. I could go then, since they're keeping it, I could go to Kelley Blue Book and look up the value of the car and use that as my deduction. This is what a 1098C looks like. Generally, you're not going to see this. Every time that I've seen a car being donated and deducted, it was just a simple letter. Thank you for your car donation. This is what we sold it for, so therefore that's the amount you get to write off. So Brad donated his Jeep Wrangler, bought for new for $22. Fair market value now says it's worth $99.50. He's got a 1098C, shows that the car was actually sold for $7, so he can only write off $7. Some other itemized deductions that we're talking about. Let's see here. Gambling losses. This is basically more or less what's left. To write off gambling losses, I need the date and the specific type of wager or wagering activity. I need the name and the address or the location of the establishment where we're doing the gambling. I need the names of other people that were present with you at the time that you were doing the gambling and lost. And I need the amount lost. And we can't go over, it says the amount of gambling winnings this year, according to OB3, 60%. Used to be I'd say, okay, well, here's how you keep track of this. When you show up at the casino, go to the ATM there, withdraw out the money that you're going to use for gambling. And for a while that was acceptable, but then the IRS decided, well, there's no guarantee that you actually took that money out and went gambling with it. Maybe you took that money and went and bought steak dinner with it, so we're no longer going to allow that. What they want you to do, and stress this with your clients, the other thing that they don't necessarily like is that the letter from the casino. What does the letter from the casino represent? Well, it represents every time I swiped my card to make a wager. The IRS doesn't like it because there's nothing that stops me from letting somebody else borrow my card. So, therefore, that's not my loss. That was his loss. I can't prove it. They want an actual journal. So stress this on your big gamblers. Okay, you want to write off your losses, that's fine. Here's what you need to start doing according to the IRS, or you run the risk of them throwing it all out. And tell them the day that you're making the wager, what you're wagering on, how much the wager was, where you were at, and maybe it's at the casino, maybe it's on the sport book on your phone. So, instead of name and address, just say, well, it was on FanDuel on my phone. You might be alone at that point. I don't know. But basically, this is what you're shooting for. This is what the IRS wants. Right, so refreshing some of the things I did cut out, but some part of it is because we already talked about it. Standard deduction depends on your age, your filing status, your vision. Whether or not you're able to be claimed is dependent on somebody else's return. Can't take the standard deduction if you're married filing separately and the spouse itemized, or you're a non-resident or dual status alien during the year. I can only get what I could write off on an actual Schedule A. You can, let's see here, the amount of income tax on your filing status and the taxable income. Unless otherwise required, if your taxable income is less than $100,000, use the tax tables. If it's over $100,000, there's tax formulas. And again, the reason why I don't really cover it in the scope of a rapid class is that it's not important. Computer handles all of that for you. Long-term capital gains rates are capped at a lower rate than ordinary income tax, and it could be as low as 0. I didn't keep it. Again, I consider capital gains outside of the scope of a rapid class. All right, I got one more chapter I want to cover with you guys today, so give me 5 minutes to rest my voice a little bit and rehydrate, and then we'll cover earned income credit. So we'll see you in 5 minutes. Alright, sorry if that took a little longer. The coffee machine had turned off. I had to get it warm up a little bit before I could brew some coffee. So, the last thing we're going to talk about today is some earned income credit. And if I remember correctly, there's a due diligence module that's attached to this. If not, then there's another one at a different chapter. So either way, due diligence. So this is going to be covering our earned income credit section, and this would also be our lecture to cover due diligence. We want to distinguish between non-refundable and refundable credits. This is going to be a theme for a bit, as we're going to spend today, the rest of today, and part of tomorrow talking about tax credits. And we're going to want to know how to figure and report earned income credit. So tax credits, unlike deductions, which reduces the amount of income that's subject to tax, a tax credit is a dollar-for-dollar reduction of the tax itself. It's a payment. Some are non-refundable, some are refundable, and there's one out there that I can think of off the top of my head that's both. 60-40. Tax credit can substantially reduce the amount of taxes owed or make a tax refund big. Not all tax credits behave the same. Non-refundable tax credit is a dollar-for-dollar reduction of your tax that can get your tax liability down to zero, but that's the best possible result. If the amount of your credit is more than the tax, I don't get what I didn't... I've mislaid my glasses. Oh, there they are. If I have a $2,000 non-refundable tax credit and only owe $1,000 in tax, that leaves me with $1,000 left over. I don't get it. It's a non-refundable credit. Hey, at least I don't owe Uncle Sam any money this year because I paid all my taxes with my credits, but I don't get what's left over. A refundable credit is treated as cash as far as the IRS is concerned. So what's ever left over, I actually get. There's a few tax credits out there that are refundable. The one we're talking about right now, earned income credit, is one of those. Whatever you have left over is what is going to be included in your refund. So, Schedule 3 covers is where you'd put in the tax credits, and then they would go to the Schedule 3 feeds a couple of different areas of 1040. But all of these are tax credits. We are not going to talk about all of them. We're just going to talk about the most important ones for our needs. I'm still trying to figure out how much I want to talk about education credits. You'll find out tomorrow. But right now we're going to focus on earned income credit, also known as EIC, or if you're watching the IRS stuff, they call it EITC, Earned Income Tax Credit. This is designed for people who work and have low income. What happened to my page? Yeah, darn it. It wasn't part of the package I printed out. I should have. In just 1 second, I want to look something up here real quick. All right. Forgive me for looking something up for you. I wanted to kind of give you some updated numbers on this. It's here. So it says that the maximum that could be earned and still qualify for the credit is 66,000. 819 for 2025. The maximum number now is up to 68,675, but that's not saying much. What you have to think about is when you're talking about earned income credit, it's what's called a bell curve. So it starts at 0 and then it works its way up to a maximum point. As you earn more money, it starts working your way down until you get to the 68,675, where you're again back at 0. So, I mean, there's a point where, yeah, I qualify for earned income credit. It was $5. Big deal. But, it can be a big deal. The maximum amounts that the maximum amount of the credit is 8,046 in the best. So the top of the bell curve is 8,046, given the perfect storm of situations. 596 provides 15 rules that must be met to be able to claim earned income credit. Some rules apply to all taxpayers, while others only apply depending on whether or not you have a qualifying child. So for 2024, AGI must be less than these numbers. Like I said, I've got the updated numbers here for 25. So let's see here. AGI must be less than oops, 61,555, or married filing jointly, 68,675. That's with 3 or more children. Married filing jointly, 68,675 again, and 57,310 for 2 children. For 1 child, 57,554 for the married filing jointly. 50,434 for 1 child, and for no children, the married filing jointly 26,214. The single people 19,104. So that's how much money you can make and still qualify for earned income credit. Remember, when you're close to those thresholds, it's not very much. So Chuck has 2 qualifying children, files head of household, 48,005. His adjusted gross income is 56,864. So for earned income credit, his income is 48,500. However, we also have to look at both numbers. We have to look at his earned income, and we have to look at his adjusted gross income. And whichever one gives him the worst result is the one that we have to take. Unfortunately for Clark, can't claim earned income credit because he's made too much money. Rules for everyone: you must have a valid Social Security number for yourself, your spouse, and all qualifying children that's going to be on your tax return by the due date of the return. And if it's not going to happen, I can file extensions to buy myself some extra time. But once I file it, I can't go back and fix it. Can't claim EIC on either the original or amended return if you or your spouse filing jointly did not receive a valid Social Security number until after the due date, including extensions. If you or your spouse do not have a valid Social Security number on or before the due date of your tax return, and you later get one, can't file an amended to fix it. If the filing deadline of your return is approaching and you or you don't have a valid Social Security number, you may want to consider filing for an extension to buy you a little bit more time. But once we get to October 15th, if you don't have it, you're going to run out of time. You can apply for a Social Security number by filing SS5 with Social Security Administration. Child cannot be a qualifying child in figuring EIC on either the original or amended return if that child does not have a Social Security number until after the due date. Social Security numbers that say not valid for employment and ITINs do not qualify for EIC. If you or your spouse do not have a valid Social Security number on or before the due date, enter no on the dotted line next to line 271040. If you're separated from your spouse and not filing a joint return and had a qualifying child live with you for more than half the year, you can claim EIC if you lived apart from your spouse for the last 6 months. Remember, we talked about this. You're married, but you're not going to file together. You didn't live together for the last 6 months. You're head of household considered unmarried. Or the other one is you're legally separated and a written separation agreement or a decree of separate maintenance, and you didn't live in the same house as your spouse. Everybody on the return to qualify for EIC must be U.S. citizen or resident alien all year. If you or your spouse were a non-resident alien for any part of the year, you cannot claim the EIC unless your filing status is married filing jointly. You can choose to file jointly only if one spouse is a citizen or resident alien, and you choose to treat the non-resident spouse as a U.S. resident. If you're going to do that, then you have to include that person's worldwide income on your tax return, though. If you or your spouse were a non-resident alien for any portion of the tax year and your filing status is not married filing jointly, enter no on line 27. If you file 2555 for foreign earned income, you don't qualify for earned income credit. If you have investment income of more than $11,600, you don't qualify for earned income credit. Investment income could be from Schedule E, it could be from stocks, it could be from a combination of dividends and interest. Doesn't matter. To qualify for earned income, you must have earned income. There's a reason why it's called the earned income credit, because you're getting rewarded for working. If married filing jointly, this rule is met if at least one spouse works and has earned income. If the other one's a stay-at-home, that's not a problem. For most people, they're going to get their earned income on a W-2. However, we will note that net earnings from self-employment are also considered earned income. So an example, Lance's only income is from Social Security and investments. No matter whatever circumstances, Lance doesn't qualify for earned income because he has no earned income. You can elect to have your non-taxable combat pay included as earned income if it helps. If it doesn't help, then you can elect not to do it. If you choose to count it, it doesn't change. It doesn't change your taxable income. It just helps you qualify for more earned income credit. And remember, we talked about this before. Form W-2, Box 12, Code Q is combat pay. It wouldn't be included on line 1 of your 1040. Well, like we said, we can make the election, find out whether or not it helps us. If it helps us, we count it. If it hurts us, which it could, remember the bell curve, work on our way down, then we can choose to ignore it. Taxable long-term disability benefits received before reaching the minimum retirement age are considered earned income. It might be on a W-2, which is pretty straightforward. I don't have to worry about it. But if this money shows up on a 1099-R, if Code 3 is in Box 7, then I'm great. Then I don't have to worry about it. If it's any other number, then there's not much I can do with it. It won't be treated as earned income. But if it's Box 7, Code 3, I can treat it as earned income. Linda's in the military, single, provides a home for her only child. Her income on a W-2 is $2,000, but Box 12 with Code Q has $23,000. EIC without the election for combat pay, $689. Election with combat pay, $3,845. Yeah, she should count it. If you have a qualifying child, rule number 8 applies. You must attach a schedule EIC to your 1040. Claiming the EIC with qualifying child. Qualified child must meet all of the 4 following tests: relationship, age, residency, and joint return tests. Hey, we've seen those before. These are the same tests that we have for the qualifying child for dependency. Except for EIC, I'm not worried about support test. Because again, this is designed to help the working poor. There might be a point where the state is providing support. But we're not going to figure that here. We're not going to worry about that here. I mean, this whole thing could be, or this whole credit, at one time, they really stress on the fact that your family could be living in a homeless shelter. And as long as we have a letter from the president of the homeless shelter, whoever the administrator is, saying that, yeah, no, I saw them sleeping together as a unit all the time, or at least for over half the year, then they were going to qualify for EIC because they were working poor. I mean, that's the whole idea. Earned income credit is just that. It's to help the working poor. Alright, so relationship test. To meet the relationship test, the child must be your son, daughter, stepchild, eligible foster child, or descendant of any of those, like your grandchildren. Brother, sister, half-brother, stepsister, stepbrother, stepsister, or descendant of any of them, including your niece and nephew. And by the way, if you're claiming steps and they're not married, they can't do it. So, step implies that you're married, or at least at one time. Now, if you're divorced, no, you can still count as step. So, be careful, be very careful about putting down stepson or stepbrother and they're filing as a single person. You need more information to make sure that they're not actually married. Because there's rumors out there, there's words out there. Well, go file as head of household. You'll get more money on EIC. Well, that could be true. There's a definite possibility that could be true. Because if you're married filing jointly, you're going to have to count everybody's income. If you're married filing separately, you don't qualify for the credit. So, some people want to try and pull that off. So, be careful about when you're talking about steps. They have to be married at some point to actually make that work. Julie's nephew Al, 14, lived with Julie since Al's parents passed away 3 years ago. Al meets the relationship test because he's the child of her brother. Now, the IRS could ask for birth certificates to prove all of this. So you need Al's birth certificate, you'd need her brother's birth certificate, and you need her birth certificate to be able to complete the circle to get Julie related to Al. And the IRS could ask for that. My question to the client is could they prove it? Grandchild is descendant of your son, daughter, stepchild, or adopted child also includes great-grandchildren. Child does not have to be your dependent unless the child is married. Married child is qualifying that you claim as a dependent. Or the only reason why I'm not claiming is because I've signed an 8332. But EIC is one of those things that's non-transferable. So even though not listed on my tax return as a dependent, I still can use that person to qualify me for earned income credit. Adopted child is always going to be treated as yours. So I even hate using the term adopted at that point. Once you've signed the final papers, it's yours. Foster child, if it qualifies if they're placed with you by an authorized placement agency. That includes the state or local government, tax-exempt organizations that are licensed by the state, Indian tribal governments work, an organization authorized by an Indian tribal government. That also works. Around here, I see Catholic Charities doing it. Hey, that's not a problem. That works for me. Age test. Child must be under the age of 19 at the end of the tax year and younger than you or your spouse if married filing jointly, or a full-time student under the age of 24 at the end of the tax year and younger than you or your spouse if maybe filing jointly, or permanently and totally disabled. This is true if the child cannot engage in any substantial gainful activity because of physical or mental conditions, and doctors determine the condition has lasted or can expect it to be lasting continuously for at least a year or is fatal. Again, we've seen these rules before. Todd, 19, at the end of the year, lived with his father who supported him. Todd does not go to school, not disabled. Unfortunately, Todd does not meet the age test because he's not under 19. So, based on that, his dad can't claim earned income credit with Todd. He still might qualify by himself. I don't know. Don't have enough information. Thelma, 25, cannot be gainfully employed because of severe physical disability. Doctors determined that the condition has lasted at least a year. So Thelma meets the age test because she's permanently and totally disabled. Of course, I'm going to want the doctor's letter stating this as proof, or if she's receiving Social Security disability, I just need the either the payment of the SSA 1099 or the awards letter from Social Security Administration. Something. Any of those things will work. Child must have lived with you in the United States for more than half the year. Can't claim EIC if your child did not live with you for more than half the year, even if you paid for most of the child's living expenses. Temporary absences due to special circumstance do not account against you, so if you're living apart because of illness, school, military service, detention of a juvenile facility does not count against you. And of course, a child who was born or died during the year or both is considered to have lived with you for the entire year and does qualify. The United States includes the 50 states and D.C., does not include Puerto Rico or any other U.S. possession. The IRS may ask you for documents to show you lived with the qualifying child. We ask for them also. That way, that if the IRS asks for them, we already got them. We're just heading it off at the pass. Child cannot file a joint return with the spouse unless they are filing a joint return only to claim a refund of estimated taxes or income taxes that were withheld from their paycheck, not claiming any other credit. We've talked about that before too. Only one person gets to treat the child as a qualifying child, which is consistent to what we've already talked about. Doing so entitles that person to claim all the following benefits: child tax credit, additional child tax credit, other dependent credit, although that one could be signed over, head of household, credit for child and dependent care expenses, the exclusion of income for dependent care benefits, and most importantly today, earned income credit. No other person can take any of these benefits based on this child. If you have another, then you can do that, split it up. That's a possibility, providing that you meet all the other tests. If you and the other person have the same qualifying, you and the other person could decide which one of you will treat the child as a qualifying child. Had this before. Grandma lives at mom's, or Grandma has a little place out back, so she shares the address with her daughter and her grandson. We can run comparison tests, some practice returns to find out where should we put the grandson, on whose return should the grandson go to get the most earned income credit. And it's totally acceptable to the IRS. Of course, there are tiebreaker rules. We've already talked about this. The IRS has their tiebreaker rules. Remember, tiebreaker number 1, actual biological parent. Tiebreaker 2, let's see. If the parents file a joint return together and can claim the child as a qualifying child, is created as the qualifying child of the parents. If the parents do not file a joint return together, but both parents claim the child as a qualifying child, the child will be IRS will treat the child as the qualified child of the parent who the child lived for the longer period of the year. That's talking about nights. If it's the same, then we break down to adjusted gross income. If no parents claiming, the child is treated as the qualifying child of the person who had the highest adjusted gross income for the entire year, assuming that we met the residency requirement. If a parent can claim but doesn't, the child is treated as the qualifying child of the person who had the highest adjusted gross income for the year, but only if that person's AGI is higher than the highest of any of the other parents that didn't claim but should have. So we're just not going to farm it out. You got to be able to kind of support your, I didn't claim them because I shouldn't have. So for an example, we have Wanda, 4-year-old son, lived with Wanda's mother for the entire year. 3 people living at one place. This basically is a rehash of what I just said. Wanda made 14, Mom made 20. Wanda does not meet the age test because she doesn't go to school. She's 24. She's aged out of being a qualifying child. Wanda's son is a qualifying child for both Wanda and her mother. However, only one of them can use him. Wanda and her mother can choose who will treat the son as a qualifying child to claim EIC. If they cannot agree, Wanda's going to win. If the child is treated as a qualifying child of the non-custodial parent under the rules for divorced and separated parents, this is the only time the tax benefits will be divided between the two tax. Now remember, I can sign over child tax credit, additional child tax credit. Can't sign over earned income credit. That's what they're talking about. That's the only place where we've split the benefits. Head of household filing status and EIC may be claimed by the custodial parent or other eligible people. If the child is the qualifying child of more than one person for these benefits, then the tiebreaker rules just determine which one will be able to claim the child for head of household and EIC. You cannot be the qualifying child of another person. You run back to Wanda, make her 18. She could be the qualifying child of her mother. Then we throw the whole thing out. Wanda's mother should be able to claim both of them. You're not the qualifying child of another taxpayer if the person for whom you meet the relationship, age, residency, and joint return test is not required to file an income tax return and either didn't file one or only filed one to get back withholdings and no other tax credits. So at that point, you've looked at Wanda's mother, although we know that she did have to file a tax return, but if she would have just filed a tax return just to get back what she was withheld, then we could have Wanda could actually have gone ahead and claimed herself and her son given this scenario. If you don't have a child, it's harder to qualify for earned income credit, but it's not impossible. So first of all, you had to meet rules 1 through 7, but we also meet these other following requirements. By the end of the year, you must have been at least reached age 25, but cannot be 65 or older. So you can only claim earned income credit without a child between 25 and 65. Again, those ages only apply if you're applying for earned income credit without a child. If you have a child, throw out the numbers. Those numbers are not relevant. Married filing jointly, you meet the test if only one of you is in that area. If the other one's too young or too old, if one's too young, too old, but the other one's between 25 and 65, and we have no children, don't care. You still qualify. You cannot be a dependent on somebody else's return. If you can be claimed as a dependent on another return, you cannot claim EIC even if the other person does not claim you as a dependent. You cannot be the qualifying child of another person. This is true even if the person for whom you are the qualifying child does not claim the EIC or meets all the rules to claim EIC. You're not the qualifying child of another taxpayer if the person for whom you meet the age, relationship, residency, and joint return test is not required to file a tax return and does not do one or just files to get back withholdings. Rule 14. You and your spouse must have lived in the United States for more than half the year. Rule 15. You must have earned income and it must be less than the limits that we've already talked about. Schedule EIC must be completed if there are any qualifying children. It's really easy, and we don't even have to do it. Fusion will take care of it for you based off the information you put in the dependent section. Basically, all Schedule EIC does is ask for the child's name, child's social security number, and the child's birthday. Remember, on EIC, we're only counting the first 3 children. If they have 7 children, that doesn't help them for EIC. It helps them for child tax credit. Does not help them for EIC. So when doing this, if I have the choice, I always put down the youngest children because the IRS always likes consistency. And with the youngest children being listed on there, they're the ones that will be on there, staying on there the longest. It doesn't look so shady. So again, to talk about qualifying for EIC, everybody has all these things in common. Got to have an earned income. Got to have a social security number. Can't be married filing separately. Can't be a non-resident alien. Cannot be a qualifying child of another person. Can't file foreign earned income. Can't have investment income of 11.6 or more. So when we talk about claiming earned income credit, the most common mistakes is claiming a child who's not a qualifying child of you. That's that step situation I was talking about. Married taxpayers who incorrectly file a single or head of household, again, that's kind of that step situation I was talking about. Or you have people that come in and who are actually married but think, or they might be right, they might not qualify if they include the spouse's income. The two of them together make too much money, but she comes in separately and says she's head of household. She might qualify in that situation, and so that's what they're doing. We have to be on the lookout for this as a fraud indicator. Over or under reporting income. If your income is all W-2, I'm not worried about line 3 here. But if you're Schedule C, and you're just kind of making it all up, you don't have a 1099 NEC, you don't have a 1099 miscellaneous. It's just basically based off of your words. Yeah, I have to look at it with a more discerning eye. I just can't take you at your word. I'm going to need a little bit more proof. Another error on EIC is incorrect social security numbers, but generally that's probably going to reject out of hand. Claim the credit if you're doing it by paper. This is the way that you would do it. You'd fill out these worksheets. I'm not going to spend any time over them because it's beyond the scope of a rapid class as far as I'm concerned. But here's what you're doing if you're doing it on paper. If your AGI is below the threshold, use your earned income to look up the earned income credit amount on the table. Don't confuse the EIC table for the tax table. They look very similar. Make sure that you're looking at the EIC table. Again, this is going back to that worksheet that I told you I was going to skip. It's a little bit more involved than it kind of looked at the beginning, but I'm not going to go over it in detail just because, like I said, it's beyond the scope of a rapid class. That's the worksheet for the EIC. I told you about the Schedule EIC. It's really easy to fill out because basically all it's asking for is name, social security number, birth year. That's all I need. And that's already on the dependent section. So, as we talked about a little bit before, paid tax preparers have to exercise due diligence. We are the IRS's first line of defense. especially when it comes to refundable credits. There is a penalty of $635 for each failure to comply with due diligence requirements. That's per occurrence. That could happen multiple times on a single tax return. Multiply that times the number of tax returns. It could get out of hand real quick. Don't worry about it. In our system, there's really no way for you to be exposed to that, because not only are we expecting you to monitor the situation, when we do double check, we expect our double checkers to apply the same standards. And so therefore you're not going to be exposed to this, because somewhere along the line, we've covered enough to say that we feel confident that this information that we were giving, that we're reporting, is correct to the best of our knowledge, to the best that we could prove. Because, let's face it, there's some great liars out there. Washington's full of them. And so, that's not a due diligence breach. They lied to you, and they were good at it. That's not a finable offense. But as a paid tax preparer, we need to know the laws. We need to ask questions. If it smells fishy, hey, I've said it before, I'll say it again. Sometimes the best result is not doing the tax return. And I'm fine with that. We want to get all the facts by asking all the right questions, and we document as we go. We just don't ask the questions and listen for the response and well, the IRS wants to know, okay, what did you ask? What was said? And we have to write it down, and it is part of the tax return. That stuff is in Fusion. It will say, well, put in the question, put in the answer, and when you put in the answer, don't doctor it. Put down the answer of what was actually said. If you ask, hey, where's the baby's father? And it comes back as, I have no fucking idea where that fucking bastard is. That's what you're writing down. Word for word. That's what the IRS wants. Form 8867 is our due diligence checklist. Only paid tax return preparers need to complete this. That's us. Only complete the columns corresponding to the credits that were claimed on the return that you're filing. Again, this is all in Fusion. So we're going through these lines, asking these questions, and then there's a part in Fusion where we can ask even more questions. So to comply with knowledge requirements, we just have to do this: apply common sense standard to client provided information. Hey, if I've got W-2s, that's common sense. That works for me. I don't really have much of a conflict. But if you're telling me information and say, yeah, I made $12,000, I had no expenses, is that common sense for me to just accept that? Show me a business that has no expenses. That's not a common sense thing. Evaluate whether the information appears to be complete or identify missing facts. Again, it comes up and says, I made $12,000, but I have no expenses. That's not complete. Show me a business that has no expense. Determine whether the information is consistent. Recognize contradictory statements or that are inconsistent with what you know to be true. She says she's not married, and then the phone rings. It's sitting there on the desk, and it says hubby. That's not consistent. Conduct a thorough, in-depth interview every year with every client. Some clients get frustrated. You asked me that question last year. Well, that was last year. This is IRS world. Each year is its own photograph. Each year is its own thing. Ask more questions when the client information appears to be incomplete, incorrect, or inconsistent. And sometimes that's how you get clients to walk. I don't want to file this return. I'm not comfortable with what I'm hearing. And you haven't given me enough information to make me feel better. So I'll bury you in questions until you get so frustrated you walk out the door. That's acceptable. Either you're going to answer my questions and I'm going to feel good about it, or you're going to get mad and leave. Either one, I win. Help the taxpayer understand the documentation she should have to support the claims. Hey, some people are new at this. I'm not saying that everybody's out to get you. That's not what I'm saying. It's just that sometimes they just don't know better. They just think it's enough to say, "Oh, yeah, I made $12,000. Yeah, okay, great." No, it's not enough. That's not proof of a business. We need more than that. The IRS is going to want more than that. Let's help you set something up. We have to make sure that the taxpayer is not underreporting or even overreporting income by asking the necessary questions to determine that the income that's being reported is correct. Again, I'm focusing on our Schedule C people. We know that they know that all you have to do is look up in the earned income credit table for the amount of dependents that you're going to have on your return to find out where the sweet spot is to get you the maximum amount of earned income credit. We all know that number. We can look it up. It's a public record. And if you're telling me is around that number, already I have alarm bells going off in my head. How'd you get here? It might be legit. I'm not saying that you're trying to pull fast one. I have to look and make sure. Double checkers will have to look and make sure. Qualifying child issues are the most common reason for earned income credit errors. Taxpayers may be claiming a child who does not meet the age, residency, or relationships requirements. Again, talking about steps on that. Residency. Did they actually live there? If I believe the information furnished is incorrect, inconsistent, or incomplete, ask more questions. Some causes for concern: claiming children other than son or daughter, niece or nephew. Why isn't the parents claiming them? The age of the taxpayer compared to the age of the qualifying child is inconsistent. Let's see here. If I run the math backwards, according to your age and the age of the child, you had this child when you were 9. Is that consistent? I don't think so. Very young taxpayers with qualifying children who could potentially be the qualifying children of themselves. I'm not saying that the 18-year-old left home and is fending for herself. I know examples where this was actually true. She was even younger, but she was making it on her own. I'm not saying that that's not possible. Just ask more questions. Single taxpayers with young children and no child care expenses. That's a great question. Hey, when you went off to work, who's actually watching the kid? If you told me that grandma's watching, that's fine with me. I don't care. I just need to know. Who's watching the kid? And I never, ever, ever want to hear, oh, they go to school. Well, that doesn't cover the entire year. There are 3 months of the year where there's no school. And who watched the kid on, spring break? Who watched the kid during winter break? Who watched the kid during conference release day? Claiming a disabled adult as a qualifying child. Make sure you have your letters. And this is basically just a rehash of what I've been talking about. When we get down to record keeping, that's happening automatically. As we log our answers into Fusion, it is being saved to the cloud. It will be there as long as Liberty exists. So some examples that we're going to run at you during the interview process. Taxpayer informs you that she is separated from her spouse. Child lives with her. She wants to claim for EIC. We look at the records. It's apparent that she earns very low income, not sufficient to support a household. So it's not rent. That's Brenda's favorite question. All right, how much do you pay in rent? And they don't think about it, and they just rattle off a number. Well, you take that times 12, and that's more than what you're showing me here on this W-2. What's going on? So we ask questions to determine if head of household is the correct filing status for the taxpayer. Maybe single is the appropriate one. Did she have access to non-taxable funds, so like veterans benefits? She's living off her savings. Hey, this is one thing, look at last year's tax return. If you got paid $10,000 on a tax refund, that's a lot of money. So if you look at that $10,000 and the $10,000, for instance, that's on the W-2 in front of you, that's $20,000. All of a sudden, you went from a very low income to, well, no, it's doable. So, I mean, look at all look at all the situations. Look at last year's tax return. Ask those questions. During the interviews process, we have an 18-year-old mentioned she and her daughter live with her parents. She only made $3 from a part-time, wants to claim EIC. Well, on the surface she can, but we need to find out whether or not it's her parents that actually should be claiming her and her son. Or daughter, sorry. Therefore, we should ask questions to determine if she may be somebody else's qualifying child. First question to consider is, did she live with anyone related to her during the year? For the relationship status. We can also see her income level is low, which may indicate she did not pay over half of her own support. So we're at support test. Upon discussion, you, the taxpayer, identify the taxpayer as a qualifying child of somebody else. We ask this additional question to determine if that person either had a filing requirement or filed and claimed EIC using you, your client. If yes to either, we got to explain to your client, sorry, can't help you file for EIC. Now, we could help you file for a tax return based on your income and that you were claimed by somebody else. You might be able to get whatever was withheld from the $3,000. Taxpayer comes in to have her return prepared. Mary states she is head of household, 2 children, 13 and 14. Self-employed as a babysitter, made $12,000, no expenses. Well, I have a problem with that. Ask appropriate questions about expenses related to babysitting business. What records have you kept? One of the questions when we talked about EIC, and when we're going to talk about Schedule C, is, are you behaving in a business-like manner? If you're not keeping records about expenses and telling me that you didn't have any, you're not keeping records about your income, you're just telling me that you made $12,000, but you can't prove it, you don't have a log, you don't have a journal, you don't have a receipt book, are you behaving in a business-like manner? No. So instead of putting the $12,000 on Schedule C, and then having it treated as earned income and potentially getting in trouble with the IRS because I didn't ask enough questions, I can put the $12,000. I could say, well, I'm not behaving in a business-like manner. I'm going to put the $12,000 down here in other income. Other income is unearned income. It won't qualify for her for EIC. So I've accomplished due diligence. You're not operating in a business-like manner. This is hobby income. And that gets me off the hook. Chances are she's not going to file a tax return because her refund's not going to be anywhere near to what she thinks. I mean, she'll still qualify for child tax credit and additional child tax credit. So, I mean, there is that. I mean, I'm not completely shutting her out. I'm just putting it in a place, and this is how you tell the client. It gives the IRS the least amount of reasons to audit you. Taxpayer James comes in to have his return prepared. He's 25, states that he has 2 nephews, 10 and 11. Obviously, my first question is why aren't the nephews being claimed by their parents? You should ask the appropriate questions. Request adequate documentation. I need a piece of paper. I'd love to have a piece of paper from the parents saying, we're not going to claim our nephews this year because of whatever reason, and we're authorizing James to claim our sons. Additional questions. Which one of the boys' parents are you related to, mom or dad? A question. If the IRS requests, can you come up with enough birth certificates to establish the actual relationship? And it could be my marriage, so, maybe I don't need all the birth certificates. Maybe I need a marriage certificate. Should explain items that verify residency and confirm James could provide proof if requested. Hey, I want that. Do I have a letter putting them at your place. The school record or the bus stop. Where's the bus stop? They're 10 or 11. They're going to school. How are they getting there? They're riding the bus. Great. What's the address of record at school? After completing the return, to receive the renter's credit on state return, the taxpayer said paid $1,000 a month for rent, $12,000 for the year. But if I recall correctly, you only received $1,100 or $11,000 in income. And after we put the expenses in, you only had a profit of $9,200. My information is not adding up here. I need to determine whether or not we have more income. How did you cover that difference? You told me you only made $9,200 and you spent $12,000 on rent. The math isn't working. How did you cover everything else? How did you cover the rent? Ask more questions. So a tax credit is a dollar for dollar credit against income taxes that were owed. Non-refundable credit reduces or eliminates income tax but will not generate a refund, just based on those. A refundable credit reduces or eliminates the total tax and generally generates a refund of any amount that's left over. A qualifying child for EIC meets the relationship, age, residency, and joint return test. So basically you have a qualifying child. You need to have earned income to claim earned income credit. The amount of the earned income credit is based on filing status and is found in the earned income credit table. It's also based on the amount of children that you have. You can elect to include or not include non-taxable combat pay. It depends on what gets you the best result. Refundable credits include earned income credit, the additional child tax credit, the American Opportunity Credit. On that one, only 40% refundable. Paid tax preparers should ask sufficient questions to comply with their due diligence responsibilities. Preparers do not have to verify the taxpayer's Social Security number with the Social Security Administration. I'm not worried about that. It'll bounce as soon as they electronically file it if it's wrong. Paid tax preparers are subject to a penalty if they do not exercise due diligence in determining eligibility for EIC, child tax credit, additional child tax credit, other dependent credit, American Opportunity Credit, and head of household filing status. Fine $635 per instance. Don't worry about that. I mean, we're going to make sure that you exercise due diligence. No return is going out that hasn't been double checked. 8867s must be retained for at least 3 years. Also not worried about that. Everything's saved to the cloud. It'll be saved longer than that. So that's today. Got one more day left for you. We'll cover, I believe I've got 3 more chapters scheduled for tomorrow. So we'll talk to you then.